case you're wondering, square root of 12.
Oh, good. Let me write that down.
That's pi. Did you say, oh, you did it on your phone, 3.46?
Yeah, that's like,
I don't know why I would ever need the square root of 12, but if I need it, I'm going to you.
And then do I have to show something?
yep, you're gonna close that window.
This one?
You got it? All right, see you later.
You're all set. Thank you.
Okay, I'll call meeting to order at 6:04. Jen, you want to do the roll call?
Clark,
Here.
David, Jay, Anthony.
Here.
Matthew, Richard, Bill, I see right in front of me. Tim,
Here.
Mitch,
Yes, here.
Sam, and John.
Here.
You have a quorum.
Okay, first order of business is the meeting minutes from our last meeting, which was
December 12th.
December 12th. Do we hear a motion to approve the minutes? Are there any corrections? Changes?
We say motion to approve.
Yep.
Second.
All those in favor?
Aye.
Aye.
Motion carries. Is there any public participation, Jan, do we know?
Nope.
New business, we have Lockton.
Dave is there.
Oh, Lou
Janet,
signed in too.
Lisa. Question for you, Janet. Can you hear me?
Yes, I can.
Okay. So Tori, our actuary, is trying to get on, but she's
I'm
having
moving
problems
her.
connecting.
I'm actually, she's in as an attendee. I'm moving her to panelist. So she should
Okay,
be
thank
able.
Okay, good. Thank you. I'm IMing her right now. So if you just give us one moment,
Take your time.
she'll be sharing. Thank you so much.
Hello?
Hi, Tori. We can see you
All
and hear
right.
you.
Great. Perfect. Thank you.
No problem. Thank you, Janet. So when you have a moment, if you can share your screen, Tori.
Okay. All right. Can everyone see this? My screen?
Yes.
The report on the screen?
Yes.
Perfect.
Yep, we can see it. Thank you.
Okay, so the first thing that we're going to go over, I'm going to review this cost report that we have in front of us. This data is through January 2023. From here, we'll move into some high claimant information, which is a big impact on this. This is a big driver of our renewal, our projections, and our stop loss renewals as well. And then I'll hand the torch over to Dave, and we'll review the stop loss renewal and the market and how that increase plays with the market averages. So again, starting with the cost report, the first page of this is the enrollment comparison. As you can tell, the data through January is very consistent with the prior policy. So those percentages are very much in line. And if you look in that bottom left-hand corner, that policy or average enrollment by quarter, that enrollment is very consistent between members and employees. That makes it very easy for projection-wise. Our enrollment will stay very consistent. If you move over to that bottom right-hand corner, we can look at the enrollment between the three plans that are offered. A majority of enrollment is in that HSA plan, so that will be the biggest driver of your current financials to date.
Tori, can I just ask a question? Maybe it's more for Janet. The census seems to be down a little bit. You said it's fairly consistent, but it looks like it's been down since during this fiscal year. Are we
Yes.
losing employees?
So you'll see if you look at these numbers down here, it is a slight decrease of the 619 compared to the 630 level. So there is a slight decrease, but nothing percentage-wise, nothing more than 10% that we would consider a major
Right.
enrollment shift.
Yeah, I know it's fairly small, but have we lost employees and not replaced them?
We're working on replacing some of those we
We
mentioned in the
lost a
last
couple of
meeting.
employees, yeah.
Yeah,
okay.
we're having, all towns are having problems recruiting.
Yeah.
All right, moving on to the next page. Oops. We're looking at claim trends now. So this is more of a trend, an overview of your experience detail. We're looking at more than 1 year, really 3 policy years in the top half, and then about 1.5 policy years in that bottom section. So again, you can see that if we're looking at the top half, that 12-month average is pretty consistent between July 2021 and our January 23 current data. And then if we look at that bottom graph, we can get a little bit more granular on that detail. So the accrual or your rates times enrollment has stayed very consistent. That has to do with the very consistent enrollment that we have. And then in comparison, the blue line is our total cost. That would be a combination of our claims by month and then our fixed costs, which would be the admin fees and stop loss fees, that sort of thing. So you'll see that cost is very variable. We have some peaks and valleys. That just has to do with high claimants, having favorable months and unfavorable months. But overall, it's hard to see because it's kind of underneath that green line, but the blue dotted line is the trend. You'll see that the trend has actually improved. So we are actually seeing a slightly better trend through January than we were seeing through October.
So Tori, that's the fitted trend, right? Not the assumed trend in the.
Correct. Yeah, so that's your actual plan trend.
That's fitted, okay. Because my wife asked me that question. How come the trend's going down? Health trend never goes down.
Yeah, so that's good news. That means we're running favorably. Right
Yeah,
now.
right.
Well, that's just spending. That's not necessarily the per unit cost.
Yeah, good.
Right.
Okay, so
This
now
is
we're
per
doing,
employee cost, right?
so in that graph, that is PEPM level, yes. So per employee per month. Now digging into this page, this is the experience detail tabs. This is where we get a lot more granular. We can see the month by month detail and we can break out the medical costs, pharmacy, dental, and then also the fixed costs. We then compare that to the accrual. So again, that's your rates times enrollment. And then we have the loss ratio. So that far right-hand side, that percentage is a good indicator of your current standing, how you're running in comparison to your budget. I know the numbers are very small. Let me see if I can zoom in a little bit. I might have to come out of this full screen. Okay. Is this easier for you guys to read? Everyone
Yeah, a little
see
bit,
this?
yeah.
Yeah, that's
Okay.
better.
So through January, we see we have the net loss ratio of 89.2. When you remove claims over the stop loss level, our net loss ratio is our net loss ratio is 86.7. So that's a good place to stand. We want to keep that as close to 100 as possible. So that means we're running favorably in comparison to our budget today. If we look at the claim specific detail for the current policy, claims are running well. We had one really low month in September, and then a couple higher months as we move through the policy year. These higher months from January through November through January can be attributed to high claimant activity picking back up. So I know last year we spoke a lot about having some unfavorable high claimant activity, having a couple more high claimants than we are normally used to. We're seeing that again happen in our current policy, and it took a few months for those high claimants to really pop up. We are now seeing that more severe high claimant activity impacting our claims. I'm just going to quickly scroll down to this bottom half so we can see where the last policy year ended to kind of show have that comparison. So you see we started out really favorable in this first half, having claims around this $1,300 level, $1,300 level, and then claims really pick up in this later half of the policy year. That is standard. We usually see seasonality impacting claims plans this way, with having higher costs in the later half of the plan year. However, this was inconsistent, I would say, with your historical reporting. This kind of was the first year that we saw high claimants really having this much of an impact on our experience. And again, that continues through our current policy. Any questions before we move on to digging into the town versus the board?
Tori, I just tried to compare the plan expenses in here in this report to the ones as of the end of fiscal year ending June 2022.
Okay.
And they're up by about 3,000 a month for every month.
You saying mine are higher? Or my rates are a little higher?
Well, these are higher than the ones that we got in the report as of June 2022.
We will have to look, I'll look into that for you. I can kind of figure out what that would be.
Okay. Yeah, I just wondered, it was kind of weird because that report had no administration fees, but it had stop loss fees. But the stop loss fees dropped by about 10% and administration fees went up by that 10% plus another $3,000.
Okay.
So I don't know if they're just missing fees or the report I had, you didn't have a chance to allocate it yet.
Okay. I know that my report does include ARG's rebate offset, which will impact the admin fee, but you're saying the stop loss fee is different as well. So I'll look into both of those and get back to you on why my numbers would look different.
Yeah, I think last time the stop loss fee included some of the admin fee, but yeah, if you could just take a look at that, that'd be great.
Yeah, I will. Okay. So now I'll move on to, we're going to start with the town and then we'll move into the Board of Education. So we're seeing enrollment around this 170 level, kind of dropping off to around the 165 through January, 164 to be specific. But we see again that same pattern in the claims here as we were in the overall group. So we started off really well with claims actually below $1,000 in the first half of the group, and then claims picking up toward the second half. And then if we can look at the loss ratios for this group, it follows that same pattern. Favorable loss ratios in the first half of the year, and then it peaks up a little higher. However, this group, the town, is running very well. You see this overall loss ratio year to date is 66.5%. That's a very favorable loss ratio. That means they're running well below budget, and that's good news.
So may I just ask a question about that?
Yes.
Just briefly, the 66.5, that means I'm asking that we're spending, is that spending 66.5% of what's available in the budget? Is that what you're saying?
Yes, that's correct.
Okay,
So
thank you.
the total plan cost, you guys are spending $1.3 million through January.
Yep.
Your accrual is generating almost $2 million through January. So your total spend is much less than your accrual. You're running
Gotcha.
at 66.5% of that accrual rate.
All right, thank you. Is that
Yep.
is that unusual? Is that unusual, or is that
That is lower than I would say your typical self-insured client, definitely. It's not unusual. You still have plenty of time left in your policy year to make up for that additional money that's in the budget. But I would say that's lower than your typical self-insured client, yes.
okay? Thank you.
Plus from what
Can you just go back to September of 2022?
Yes.
You have $19,000 in claims. Is that a typo?
No, that's the truth. There was I can look into that, but there might have been a credit that was provided that month due to maybe an over.
Okay.
Yeah, it was a stop
Because that
loss.
just seems like
It
crazy.
was at the pharmacy.
Probably stop loss reimbursement.
Okay, thank you.
But it was a reimbursement that caused it to be
Reimbursement,
unusually low.
Hey, Mitch, you also asked about the amount. From what I remember historically, it seems like the Board of Ed usually runs about 400,000 better than expected by the end of the year, where the towns run both up above and below what was expected. So it's kind of amazing. Right now, we're 660,000 favorable for the town. I don't think I've ever seen.
We've been the
anything like
last
that.
couple years running.
Oh, really?
favorable.
Last year was good.
Yeah, last couple, not that favorable, but yeah.
Well, yeah, last year was about $250,000 at the end of the year.
Okay.
So I can go down to that prior plan year. Last year, the town finished the year at 99% on the gross basis and 93.0% on the net basis. So I would say our target is always to run at 100% of cost. That way we're not leaving money in the budget that could be spent elsewhere, and that way we're not overspending on the budget. So that 100% is our target always. So the town landed perfectly last year.
Just so you know, at the end of the year, if there's money left, which there is in the fund that we haven't used on claims, it stays in the fund because we accept the risk for both
Right.
our side and the Board of Ed.
Okay. But if the Board of Ed has money left,
They
they
get it.
can spend it.
That's why we
That's
keep
why
our
we got
money
we
in
got
the
new
fund.
carpeting and
Yeah.
John Wallace, John Patterson. Okay.
Exactly.
Yeah.
Just say, if I'm looking at this correctly, the stop loss fee is $80 per employee per month, right?
So this is the combination of admin fees and stop loss fees. However,
No, I'm talking about the stop loss fees just broken out. They're $80 per employee per month, correct?
Yes,
Okay, thank you.
that's pretty close. It's 70 something for the 74, 75 for the spec, for
for
specific,
the current.
$5 or $6 for the aggregate.
Yep.
And given that we've had some interesting experience, it's probably going to go up for 23, huh?
Yes.
Yeah.
We will-
We're gonna get into that in a minute. Let's talk about the board.
All right. So moving on to the board. The board is running right now at 96.9% of the accrual rates. That's perfectly right on target with what we would expect and what we project for. And similar, I'm sounding like a broken record, the similar story happening here. You can see the first month started out favorable. We had one slightly high month in August, but again, it dropped back down to around the upper 70%. And now from November through January, we're seeing another spike above 100% for each month. Again, that can be attributed to that high claimant information. We're seeing a lot of high claims, not only breaching the ISL level, but under the track claims over $25,000. So we're seeing a lot of claimant activity under the ISL level, which impacts each plan, each group. And that's what we see impact these later months here. If we scroll down to the bottom, we can see last year finished at 102.0%. Once we remove high claimants at 97.2%. So again, we landed right around target last year.
Now,
We
Tori,
currently
you don't split out the stop loss now between Board of Ed and town just at the end of the year, or?
So the reporting we receive from Anthem is limited sometimes with the PHI data or the identification data for these high claimants. Right. We try to request this from Anthem. Sometimes we get them, sometimes we don't. Okay. Unfortunately, through January, we did not get the PHI data with the high claimant information. We can definitely look into that and try to add these in the future.
No, that's fine. I was just wondering because I didn't see it split out. I saw it split out for last end of this fiscal year, but not for currently.
Right. But there is net claims that will definitely bring this loss ratio down and will make it more favorable.
Right. What you're going to talk about next?
Yeah, right. So next we're getting into the fun stuff, the high claimant information. I'm going to put this back to the full screen. So now we're looking at the high claimant information. We're tracking claims here above 50K. Our ISL level being $175,000. Currently through January, we have 3 claimants that have reached the ISL level. Our stop loss team did a clinical review on our large losses through January. Of the 3 high claimants that are currently already breached, 2 are ongoing. So we expect these claims to continue to accrue claims and continue to. I'm sorry, Dave. Did you have something to add?
No, I just.
Oh, okay. Sorry. Your name popped up. Okay, so we had 3 claims that are breaching, 2 of which are ongoing. There's also a 4th high claimant. The 4th one listed here, the malignant melanoma of the skin. That claimant is also expected to breach the ISL. In comparison to last year, we had 7 claimants that hit the ISL level. And so we're expecting to reach somewhere around that same level this year when we finish our policy year.
Which 2 are ongoing, the top 3?
The first 2 are ongoing.
Actually, the stomach cancer, the digestive disease, which is, I think that's the alcoholic liver disease. And then there's the melanoma of the skin. Those are all projected to be over 350,000 potential.
Yes. Okay, so, oops, that goes back to the beginning. Okay, so when we are talking about renewing our stop loss, the stop loss team, Anthem stop loss, will look at this high claimant information. They'll look at our prior high claimant information and renew based on our loss ratio from that. Our current rate in 2022 for our stop loss is $72.02 PEPM. Our locked-in average for your ISL level at 175 is about $123 PEPM. So our Newington stop loss rate is about 58% below our locked-in average. And our locked-in average is much more favorable than the market average. The market average being about 168 PEPM, and again, the locked-in average being around 123 PEPM.
Hey, Tori, could I ask a question?
Yeah.
Are those averages based on the same stop loss limit?
Yes, they are 175.
Okay, thank you. Well,
And then Dave, I will pass it over to you to speak about the renewal.
Thanks, Tori. That was very nice of you.
You're very welcome.
No, I think what Tori's outlined, and it's pretty. We had been warned by Anthem last year after we negotiated the 9% increase that they wanted more, and they asked us more. We held them to the 9%. They indicated that there were several large claims, and ultimately they ended up funding them last year. And now going into this year, they've got 3 claims that they're worried about, and the bigger issue, and that's one issue. Issue number 2 is the current Newington rate is below market average, and then in order to verify all that, we did do a full marketing of the stop loss, sent it to all the carriers that Locked-In works with, and thus far we received a decline to quote most of them, and one carrier offered 100% rate increase. So we're still in the process of trying to get a more aggressive stop loss offer on the table, either from one of the alternative markets or from Anthem. That's unfortunately where we're sitting. We're a little bit of a victim of our own success in keeping the rates as low as we have over the last few years, and that stop loss has kind of exploded. And one of the major issues is Anthem was pricing everything until this year. Anthem was pricing everything in the local offices, and they were making decisions locally. Their CEO determined that they were losing too much money on stop loss as a company, and she pulled all the pricing into one central pricing unit. And right now they're trying to right size their entire block, and they're trying to do it all in 1 year. So Anthem's not very aggressive on stop loss at all. And unfortunately, because of where we are price related in the market, we don't have a viable alternative yet to use as leverage against them.
So Dave, it's reasonable to expect like a 60% increase on the stop loss, is what I'm hearing.
I'm not saying anything's reasonable. I don't know. But I would never use the word reasonable. I would use the word that we don't have an alternative yet that makes me happy, if that's fair. And I don't expect any of you to be happy about that. It's not outside of the realm of reality in the current stop loss market and what's happening out there as far as the number of claims that can exceed $1 million relatively easily. There's new drugs in the system that cost $1 million a year. And all of that's getting put into the mix. So, we marketed this every year, and this is the first year we have not seen anybody at least try. So we've heard the market story before, but this is the first time they've actually been holding to it. If you think of it, and this is kind of, if you've ever heard of or done any insurance on like property casualty insurance, every now and then you hear about market capacity and hard markets versus soft markets. That's the best comparison that I can come up with right now, is that we're in a hard market for stop loss, and Anthem normally we'd be able to use Anthem or there would be one alternative carrier that we could use to leverage everyone else. And unfortunately, we haven't found one yet. We're hoping that as we get closer to the actual renewal date and they have more data on these large losses, that we could either get a better number on the table and use that. And the other alternative is we might be able to, we already asked for what would happen if we lasered any of these individuals out. That wasn't going to help the numbers yet. So we have a lot of people still working on this, including our entire stop loss team and our claim cost management people. So there's more to come. But right now we're looking at roughly a 60-70% increase.
Is the 175 a low threshold for a group of this size?
It's in the market. It's between 175 and 200. We're going to look at 200, but it's only worth it if we get at least dollar for dollar savings, because obviously we have 3 claims that are going to exceed it. So unless we save, if we assume that we're only going to have those 3 claims, unless we save for 175, that's $75,000 in premium. We have to save more than $75,000 in premium for it to be worth it.
Thanks.
Because we're pretty sure those are going to exceed.
So Dave, right now we're talking about a potential increase of like 400,000 for the stop loss, then 350 to 400.
Yes.
Okay.
And that's priced into the renewal and the budgets that we provided to Janet and Lou.
Oh, that's already in there?
That's already in there. So this doesn't affect, right now we're just looking to see if we can lower it. It's not, right. But the budget that, and we priced this in when we provided the budgets.
January or February, maybe?
I'm sorry?
Oh, I just wonder, when did you provide it? January or February, maybe?
January.
January.
We had a meeting on the 18th.
Okay.
Yeah, well, we had a sense when they gave us the initial renewal that they were coming in high, and we priced it accordingly to make sure that we were covered.
Yep.
And ultimately, what that came to is that the town is roughly 0, and the board was in the, I want to say 4 to 5% range.
Yeah, about 4.2.
So we don't see that.
The budgets?
Yeah, I already got the answer. Thanks.
The recording can't hear you nod though, Janet.
Yeah, sorry. No.
I've testified enough.
Well, I say Mitch and Tim will see it.
Yeah, well, someone's going to have to see it.
Well, if you look at the budget, you'll see it.
Yeah.
It's in the budget, I'm sure. Any other questions? Any other questions? See none?
No.
Okay. Okay, thanks for your good news.
Well, the budgets are good.
Yeah, we're doing well so far this year.
Yeah, sure, we've had worse. We're just trying to keep these fixed.
Yeah.
Okay. Thank you.
Dave, you're starting to sound like an actuary. It could be worse.
Well, that's later on. Wait.
Yeah.
Yeah.
People accuse me of that every now and then, but I've been an underwriter for years. Never went to the actual level. Too theoretical when you have to do calculus.
That's life actuaries and health actuaries, not P&C actuaries.
No, sir. All right. Thank you all.
Thank you, everyone.
Thank you.
Thank
Thanks a lot.
Thank you, guys.
Okay,
night.
UBS.
David, you want to take control of the screen?
Sure.
So thank you for having us. I think Ashley's there. I was supposed to be there. I had a mix-up, so I apologize. I'll be at the next meeting for David. So we'll go through this. David, you want to put the agenda up first so we can go through what we're going to go through?
Sure.
So we want to go through we have new capital markets assumptions. The last meeting, we went through the the assumptions. We're going to do it again at the next meeting because we have updated numbers since the end of last year. We're going to recap what we did in the last 12 months, which David, you want to run through that real quickly? So
Sure. We put this in here because there was a significant amount of changes over the past 12 months over several meetings. So we did reduce the overall equity exposure. The bond duration was increased slightly. We removed a few managers, the first one being Western Core Plus. We removed Oakmark International and American Funds Euro Pacific Growth and introduced two index funds, Vanguard Total International Stock Index, and the Vanguard Growth, which replaced ClearBridge. So a lot went on. We also presented an asset allocation study at the last meeting. So that we're going to do another one next quarter because, as Mark mentioned, the capital market assumptions were updated a few weeks ago with assumptions that will reflect higher interest rates and lower equity valuations as well.
okay, and then we're going to have two recommendations as we go through stuff today. We put them in wording for motions if they're accepted to make it easier. So we'll pull this back up when we get through the presentation. Any questions for us or anything you want us to talk about specifically? And this is the first time I've seen the new town council room and it looks really pretty. So Ashley says the building just is nice. So, all right. So what we're going to do is our normal format. We'll go through the markets first. It's collegial, so please ask questions or comments as we go through it. Then we'll go through the actual portfolios. David, why don't you kick it off with the first page?
Sure. And this page here we may have had in the December report, but it's been updated with year-end numbers, and we still think it's an important page when we think back at the year last year. What was unique, what was different about last year, other than the fact that the stock market was down, which is one of the things that you, when you turn on the TV, you see, you hear about. But what you don't hear much about is what the bond market did. And so what this page is showing is the blue bars represent, excuse me, on the left-hand side, 100% stock portfolio, and on the right-hand side, 100% bond portfolio. And there really isn't much difference, right? So -15 versus -24, that's not what you expect from aggressive portfolios contrasting to conservative portfolios. And so taking a step further, the gray bars on here show you the worst year that particular portfolio did going back to 1945. So for stocks, it was a bad year, but it wasn't the worst year. But for any portfolio that was more conservative, 40% stocks, 60% bonds, and to the right, it was the worst year in many, many decades.
So the only time we saw the bond market like this in the 40 years since I've been doing this was in 2008 for the bond market and the stock market. The difference was the bond market in 2008 came snapping right back in about 3 months because of dislocation in the mortgage backs. This has been going on since about the end of the first quarter last year. Second observation is we sent out an article or emailed it, I believe over the weekend, illustrating that even though the bond market has gotten hurt the way it did and the stock market did, because interest rates are going up, the liability assumption that the actuary is going to use for this pension portfolio is actually going to help a lot to offset what happened. And actually, we have a number of clients that are not municipalities that are able to sell their portfolios or their pension portfolios to insurance companies at this point. Cannot do it with the municipality, but higher interest rates also help a lot with the actuarial study on the pensions. Any questions on that?
Just one comment, Mark. I think that really applies more for private ones.
Right.
You know, because they use the low bond rates to calculate what their funded percentage is, where here we're doing,
Communities.
you know, higher bond rates.
Yep.
With stocks. So I read that article, I'm going like, this doesn't make sense to me. And then it did make sense because it's more for private companies than municipalities, I believe.
Yep.
So I just have one question. So this means there's like no safe space right now.
Well, no safe space last year.
Last year.
Once you loaded up on oil stocks or where you had a lot of cash, those are the two areas that perform well.
Yeah. Now you could argue that the safe space is bonds, specifically short-term bonds, because of what's on this chart. The red line is a visual of what the Federal Reserve did last year, using interest rates from 0 to over 4%. And all the other lines on here represent what the Fed did in previous times in history. So the previous times were much more drawn out, much more, not as aggressive. Last year was also unprecedented in them, the fact that they went from 0 to 4.5 in 10 months. And the last time they raised rates, it took them 3 years to get over 2%, which is this bottom line.
So when we look at this chart, we know you can see that the raise in interest rates or the rise in interest rates over the 10-month period that we've been through so far has been dramatic. And it was kind of like sharing. The way we're explaining it is being in good weather like today, and all of a sudden a hailstorm starts and you have to get adjusted to it. So we're trying to figure out how to explain what this meant to the economy and what happened to the stock market last year. And what we came up with is, if you think about 2008 and 2007, a gentleman named Taleb came up with the concept of black swans in the economy. And a black swan is an economic event that takes the markets down that nobody can predict. And in 2008, we had the first one after he named what could happen. And it was supposed to happen once in a lifetime or once in a business cycle. But if you look at what's happened since the beginning of last year through today, we're operating with 4 or 5 black swans at once. So we have the Russian-Ukraine incursion or war, the food insecurity that comes off of it, interest rates up, inflation up. We also have Chinese lockdown with the pandemic, which hurt the supply chains, then the opening up, and then geopolitics around the world. So we looked at that and said, okay, rates have risen because of that, but what really caused it to go up so quickly? Part of it is explainable that everybody's saying the Fed reacted late. The other part of it is we've renamed the past 10 or 15 years a white swan period, and the past 10 years more explicitly. So if you think about what the central banks did in the past 10 years was take rates down to near 0 or 0. If you look at the chart, that would go back about 10 years that were near 0. So most of you know the concept of the cost of money in operating a business, borrowing money from people, or in your own lives. The cost of money was near 0, which gave rise to companies being able to exist that probably wouldn't have existed, that profitability would go up because you didn't have to pay for your money to any dear amount. Town of Newington was a good recipient of that, being able to operate at lower cost. And suddenly we're at 4%. So we have a whole generation of CFOs and individuals that haven't operated above 1% in their personal lives, or 2.5%. We have people on our staff that have 2.5% mortgages. I don't think most of us on this had ever dreamt of getting that when we were David and Ashley's ages, okay? 2.5%, we're nuts. And I use the other example that if you leased a car 3 years ago for $200 to $400 and you went to replace that car because it's expiring, the lease is up now, you'd be paying $400 to $800 for the same car. So the cost of money has gone up. So what we're seeing and what we're doing in the portfolio is making sure that the companies that we're invested in and the credits we're invested in have good, strong balance sheets. Their debt loads are good, that the people running those firms and those companies are paying attention to expenses. And hopefully we have the right managers and positions in the portfolio that these companies will be able to grow organically as other companies go out of business, or they'll be able to acquire companies as they start to go out of business. So I explained to people that 4% sounds like it's an awfully high amount. I'm going to say this, when I started in this business in 1980, if I could afford a $100,000 CD, I would have gotten 10 5/8% on that CD, and I would have gotten a toaster or a set of glasses. It would be my choice to get it. Okay. And my first mortgage was 13 5/8%. And guess what? At those rates, the economy still was doing well. It's just getting adjusted to the rates of where they are now and where we think they're going. And for that, I will tell you in a minute where we think rates are probably going to be going. Any questions on that or any insights? Okay. David?
So the next couple of pages talk about, okay, what happened last year. We know it was a shock to financial markets, but now we're still in a narrative where we don't know what the Fed is going to do, and they play, in our opinion, a very large role in how the economy performs going forward. This chart here is really just saying that the red circles show a time in the past, 50 years or so, where the Fed hiked rates and did not lead to a recession. Although there are periods on here where the Fed rate hike did lead to a recession. So certainly we're kind of in an environment where either can happen, but this particular economy we view as very unique, because of the job market, what we'll talk about, and wages. There's also a disconnect between what the Fed says they're going to do and what the bond market thinks that is going to happen. And that's page 6 on the screen. And so the blue bar is the Fed's expectation of what they're going to do. They're going to hike rates and they're going to hold them. And the gray bar is the yield curve, or essentially what the bond market is pricing. And you can see it, there's definitely a divergence. And that's because the market thinks the Fed is going to go too aggressively, the economy is going to slow down significantly, and the Fed's going to have to pivot, reverse course, and cut rates towards the end of the year. And that's sort of the disconnect right now.
Yeah. So go on, Ashley. I'm sorry.
Yeah, so that curve is a little bit dated. In the last month or so, it's changed, where the market is starting to reflect a likelihood that the Fed is not going to lower rates this year, where they're going to keep them steady and probably raise them from this point, and then not cut until next year. So a lot has happened actually in the last month, but since this chart was printed, obviously there was a big disconnect. The disconnect is less today.
So to reinforce what Ashley just said, if you look in the lower left-hand corner, this was as of January 23rd. And this was the mantra at that point. 2 weeks ago, the PPI, or Producer Price Index, came out higher than expected. Within 24 hours, our firm UBS and Goldman Sachs came out and said, originally we thought rates were going to start coming down around October or a little bit earlier. Now we've pushed that out to the first quarter of next year. Goldman Sachs pushed it out. Both firms are now saying that rates are probably going to go up 4 more times before the end of the year, 25 basis points each time. And Morgan Stanley came out and said they don't expect rates to come down until the end of the first quarter. And PNC Bank, which is a large regional bank, is now saying May of next year. So to explain that a little bit, and the puzzle to this whole thing is, as rates were coming down, the Fed kept saying they're going to keep rates low, and they gave their targets, and the markets believed everything they said. Now the Fed's been saying that they're going to keep raising rates until the inflation is to their liking, and nobody's believing them. But the market has started to come to terms, as Ashley just said, this curve is closer now. And I'd explain it one other way, is when I came into this business in 1979, the head of the Fed was a gentleman named Burns, and we had hyperinflation. And he announced that he had beaten inflation back. And at the end of 1979, he lowered rates for the first time. 1 month later, Volcker came into office, who was the Fed chairman when inflation took off in 1980, and rates on the treasuries hit over 15%. Okay. So what we're looking at is a Fed that doesn't want to repeat what Burns did. So we'll call it that this Fed perhaps is channeling their inner Volcker. They don't want to go down in history of lowering rates too quickly. And so they're going to keep rates up till they believe inflation is beaten. And I think the street's starting to believe what the Fed's saying. Any questions on that or comments?
What's the acceptable inflation number?
Well, they want 2%, which now the talk is they're probably going to have to raise that. Fed wants to take it back down to 2. We're at much higher than that. We're 7%, around 7 at this point. A lot would have to change. Ashley, any comment on that?
Yes, so the only real question that the market is grappling with, which we can get into, is can the Fed get to their target without throwing the economy into a recession? And that's a big unknown right now, depending on who you talk to. And, that's going to have ramifications for, Fed policy, how aggressive they go. It's going to have ramifications for earnings. But, they do outwardly say 2%, but, there is some talk that internally they're considering, maybe a higher level being a neutral level, but they haven't come out and said that yet.
You want to go to the next page?
So as we shift and we think about this year, we know what happened in the financial markets with interest rates, stocks, bonds going down. This year is about the economy and how the economy will absorb kind of the changing landscape, especially with interest rates where they are. And so, there's numerous things to consider, but the biggest piece is the consumer, the individual. Right now we're at we don't have an unemployment issue, so that's not typical for a recession. The consumer makes up a very large part of the spending pie when we think about the overall total U.S. spending, and so that consumer, up until this point, is in good shape, or at least on average, right? And so there's Mark will get into the different pockets of savings out there, but this page on page 9 is showing that interest costs have gone up, and on the right hand side, the way to read this chart is in the red box. It shows the savings rate. At the bottom right, it shows that the savings rate has dropped. So people going forward are not saving what they used to, but there was a very large spike in the savings rate during the pandemic for multiple reasons. And that created a cushion, $1 trillion in extra savings. So the big question is, we have inflation that's lasting longer. How long will it take for that cushion to be eroded, and ultimately the consumer, starts to pull back?
Yeah, what we're not showing here, if we had another chart that shows credit card balances, we started to see credit card usage go up significantly over the last few months. In addition to that, housing affordability is at one of its lowest points in decades in terms of home values being higher and mortgage rates being quite a bit more expensive. So we do believe that there are some things working against the consumer today. But obviously the employment situation is still very strong, which has kept the consumer in a position to at least be able to afford most of their ongoing expenses. But these other items are things that we're looking at and, certainly can impact consumer spending going forward.
So one of the other things that doesn't show on this chart, when David went through the $1 trillion in excess savings, is right now, up until today, I've been saying that 63% of Americans are living paycheck to paycheck. As of this week, it's 60%, and I'll explain why it dropped by 3% in a minute. But that 63% of the population living paycheck to paycheck are unfortunately already in a recession, in our opinion. Okay, and they're in the worst kind of recession. They have rising interest rates and inflation and living paycheck to paycheck at the same time. That's part of that credit card bill. The inverse, the other 40%, is sitting on about $1 trillion worth of excess savings in money market and savings accounts, which is partly why you're seeing a lot of flow of funds into money markets. Most firms are now paying 4.5 to 4.7% on your savings. So we went from TINA, which, if you remember, when we had the stock booms, there is no alternative. Now it's known as TARA. There are real alternatives. You can buy bonds and you can buy money market and make 4.5+% and higher on bonds if you're willing to take the duration risk. So we're sitting on $1 trillion of excess capital that people can still spend, which explains a lot of the spending that's going on. But throw into that mix that there's over $1 trillion waiting to go into private equity that's been committed in the United States, and $1 trillion worth of venture capital that's still sitting out there. It's over $3 trillion that these rising rates have not hurt the markets at this, or these parts of the market at this point. And that doesn't reflect the rest of the world that's still sitting on excess cash. So rates are going to have to go a little bit higher before this cash starts to get dwindled away. Does that make sense?
Yep. Aren't auto loans also up, Ashley? That audit, the amount of auto loans I thought was up significantly too,
auto
because
loan-
people are going longer and they're more
They're
expensive.
no
and-
longer, yeah, people have gone to 6-7 year loans and, yeah, they're starting to come under pressure. I know auto prices are coming under pressure as
They're
well.
actually around here, John, they're 7 to 9 years now. And who would have thought that people are going to take loans out for 9 years on a car? Okay, so
Yeah, you guys are buying Teslas and stuff like that, you know.
not me. I'd have electricity anxiety with a Tesla, so it's not going to work. Okay, David.
Yeah, so I mean, the next few pages talk about some things that are normalizing. You know, and so we'll see. We don't want to, you know,
The one thing I'll say when Janet said that you're trying to fill the positions in the Board of Ed, that's every business, every municipality we're talking to, they're short staffed 10 to 25%. Doesn't matter what business we're talking to, that they can't find people to work. And when they do, they don't last as long as they used to. So it's an interesting time.
So there is some of the data is moderating, you know, wages, CPI, but again, we're still significantly above long-term averages. Demand for goods is normalizing, so that's partly what drove inflation on top of supply issues. So, but we don't think we're out of the woods yet. And our takeaway is that for the next 6 months, at least, to possibly throughout the calendar year, you know, we don't expect too much from equity markets, you know, and sort of a volatile, what we call range bound market, where you're going to get some up months and some down months, because we think we're still, you know, market's feeling its way through what the Fed is going to do and how the economy is actually absorbing all the things we talked about.
David, can you turn to the next slide?
Sure. There you go.
So I don't know if everybody can see this. There's a lot of numbers on it, but the point that I think is illustrated on this slide is we don't know which of the scenarios is going to play out. The scenarios that play out are really dependent on what happens with inflation, what happens with the Russia-Ukraine situation. Can the Fed engineer this proverbial soft landing with rates going up without seeing a real nasty economic situation? And that's unknown. And that's what the central, the upside, and the downside scenarios try to convey. Rather than try to guess which of those scenarios we're going to have, though, if you look, you'll see a skew between the upside and the downside in the central, where the upside is generally fairly limited, and the downside, there's more downside generally at these valuations than potential upside. We know that we have a Fed that's taking money out of the system at the same time that we're likely to see at least some level of earnings deceleration. Obviously, if we go into recession, historically, we see earnings decelerations or downturns somewhere in the 10 to 15% range on average, and in some cases more. So when you have a Fed that's being restrictive at the same time that earnings are coming under the pressure, that isn't typically a great backdrop for risk assets. Okay, so with that, you'll find as we go through the reports and we present our recommendations, it's in view that if that's the case, we want to try to make things a little more conservative and also take advantage of the fact that we're getting higher rates on safer instruments. So that's all I wanted to say, Dave. Go ahead.
Any questions before we move forward? Okay. Ashley, did you want to take everybody? What do you think is the best way here as far as navigating through these? And you want me to lead it?
Yeah, why don't you start off and I'll jump in.
Sure. Okay. So we'll start with the police pension. This is more recent. We like to put in anytime we're farther away from the calendar quarter, we'll put in a more recent performance and allocation. So March 1st, 58 million, just over 50 million, and the allocation to stocks is just over 60%, and the remaining in bonds and cash. The one thing to point out is the within equity, for a while we've had the majority of a tilt to U.S. stocks, which has worked out. Fourth quarter was the first time in a very long time we started to see international stocks outperform. So and we talked about this at the last meeting. We will be recommending a gradual increase to this 14.5. For the year, again, this is just taking calendar year, just so you know what's happened since December. This portfolio is up 2.8% in that time.
Can I ask a question about the international stocks? This is just more broad than just to the pension, but where is that happening?
Where?
As far as like a region, a country,
Oh, sure. So that includes, it's really anything outside the US. So you'll get the majority from Europe and Japan, but there'll also be a slice of the international portfolio in the emerging markets, which would be China, India, Brazil, no longer Russia, obviously, we have issues there. And then parts of South America and other parts of Asia would fall under that category. But typically, you know, the majority is going to be in the Europe and in Canada and Japan area.
Part of the
performing relative to, so, I mean, is there something better happening there or some kind of different viewpoint?
It's interesting. The last few years up until the fourth quarter of last year, the dollar's been very, very strong. Okay, so that's a negative for international stocks. But in the fourth quarter, what we saw is the dollar started to weaken. And so that was a positive, a big positive for international stocks. But the companies themselves, believe it or not, actually are starting to outperform their US counterparts in terms of higher earnings growth, in terms of the stocks themselves performing in local currencies. So, you know, if you look last year, I think it's 70% of non-US equity markets outperformed the US market, even in the face of a very strong US dollar. Okay, when you just look at the local currency performance, they significantly outperformed the US. So, you know, in the markets, we tend to see these extended periods of outperformance followed by underperformance. And we've had a very long period of US outperformance versus international markets, but that's not always the case. If we look going back to 2000 and 2006, 2007, there was an extended period of international outperformance versus the US. So it's possible that we are going to start to transition to that type of period. Very tough to call the timing. But if you look at those international markets today and how those stocks are priced, they're quite a bit cheaper than similar companies in the US. So the argument could be made that this is now an ideal time to start slowly increasing the allocation.
So, Ashley, I just want to throw another set of numbers with the dollar. So until the third quarter last year, most in Germany and in Japan, their markets not adjusted for the dollar were up 10 to 15%. The dollar was so strong at the end of the third quarter, both those markets were down 5 to 10% because of the dollar. So those companies have been doing well, but adjusted back to our dollar if they underperformed the US markets. So the fourth quarter shows what happens when the dollar starts to weaken just a bit and those companies are doing better than the US counterparts. Do you have that one right, Ashley or David?
Correct, yep.
Yeah, okay. So that's where it's coming from. It's mostly dollar denominated because those companies have been doing well the past 24 months.
Are the international funds we currently in, are they hedged or not hedged?
They're not hedged.
So they're not hedged. So we get the benefit of the dollar weakening.
Correct. Yeah. Hedging would cost us or the manager 3 to 5%. That's a lot to give up in terms of return. So not hedged.
So even a Vanguard one's not hedged, huh?
Yep. Not hedged.
Okay, go ahead, David.
Sure. So when we think about where we are versus the longer term target, we're not far off. Essentially, the target for bonds is 35% in US, 5% international. So essentially a total of 45%. I'm sorry, 40% in bonds. And, you know, The actual percentage is right on target for US and a little bit underweight for fixed income. So mentioned that we had started to de-risk last year to get closer to the target. And so we're within a few percentage points of the longer term target. But today we're going to talk about getting there essentially, you know, to decrease the equities a little bit once we get into the managers. So I'm a few pages after this. Ashley, do you want to go through this page with everyone?
Sure. So this is a performance summary, and just so everyone knows, the three pension plans, the police, the the admin and the municipal, are very similarly allocated. So the numbers are going to look very similar. All the same managers, very similar overall returns. But what you'll see here is on the left-hand side, it lists the categories of the managers. And so large cap US exposure we have through three managers. It's MFS Value, which is more of a blue chip type of exposure to the US markets. The Vanguard 500 Index, this is just an index fund to the 500 largest companies in the US market. And the Vanguard Growth, this has a tilt to higher growth companies. And so you can see the allocations here. We have about 18% in the MFS Value. That was a tactical decision on our part to overweight value relative to growth, because we felt that the attractiveness of the companies and the sectors that are in this respective fund are more so than in the growth index, given the growth outperformance the last 5 years. And then for small cap, you could see we have one small cap manager. That's the Kane Anderson Small Core strategy. And then on the international side, there are two managers, the MFS International Value and the Vanguard Total International Stock Index. And those are going to experience fluctuations based on the currencies of the countries, not just the company's performance as well. And then on the fixed income side, what you see here is we have 4 total managers on the US bond side, one on the what we would call global or international fixed income side, and you can see the relative allocations to each of them there. So, you know, as we look last quarter, what you can see is the areas of the market that were focused on the international markets as well as small cap bounced back nicely. Your international bond manager bounced back nicely. And we obviously had some good performance from the MFS Value Fund, which is more focused on obviously US large value stocks. So basically speaking, the majority of the portfolio was positive across the board with a few exceptions. Recall we did make a shift, and this wasn't 100% reflected in the fourth quarter, but most of it was. We did take the position out of the Western Core Plus bond manager, which is more credit oriented, and add that to the other bond manager, the DSAM Core Plus, which is a little bit higher bond quality. But when we put all the managers together, they were up about 5.6% for the quarter. And that brought us to a minus 16% return for the year. Obviously a very, very challenging year. And, you know, if you recall the slide that David mentioned, it really wasn't a big divergence, whether you were 100% equities or 100% fixed income. It was just a very, very challenging year for equities as well as bonds. But if we look longer term, the 3-year, the 5-year, the numbers, they're starting to look a little bit better there. But what I think helped last year, you know, we did get some outperformance in the last quarter from the large cap US managers as well as the small cap US manager. There was a little bit of relative underperformance from the MFS International Value portfolio on the international equity side of the equation. So I think that was a little bit of a detractor on the portfolio. And on the bond side, I think overall actually was a net positive. And the big reason for that is of the 4 managers, you can see that we have about 18 and 19% exposure to the BlackRock Strategic Income and the JP Morgan Strategic Income managers, which have very low durations in their portfolio. Templeton Global also has a very low duration, which means they don't buy long-term bonds. And so what you can see from those 3 managers is they significantly outperformed the overall bond market, and that brought your total bond performance up significantly. And overall, the bond exposure was a net positive for the year. So I'll stop there. Obviously, a lot of different managers play a lot of different roles in the portfolio. But to this point, just to summarize, we've been overweight value relative to growth. We've been underweight duration on the bond side, meaning the average maturity of the bonds we own is less than the Barclays aggregate index. And that's been by design. So any questions on the managers, on the allocations, performance, et cetera?
Nope.
So, as we alluded to at the beginning, we are going to recommend some modest shifts to the allocation based on our kind of view of the world and where valuations are. And one of the things that we'd like to do is start to add more to international equities. And we'd also like to increase the duration of the bond portfolio slightly in light of the fact that longer term rates are much more attractive today. And over the last month, they've actually run up pretty significantly. Okay, so the way we would suggest doing this, and this would apply to all of the portfolios, the police, municipal, and admin pension, as well as the OPEB. What we'd like to do is increase the international equity exposure by adding to the Vanguard Total International Stock Index by 2.5%. We'd like to take that 2.5% from the MFS Value Fund. And we'd also like to take another 2.5% from the MFS Value Fund and add that to the DSAM Core Plus portfolio, which is more of a traditional diversified investment grade bond strategy. And so this reflects our view that we think international equity markets are attractively priced today. We think that we're starting to see some better fundamentals from those markets, then the valuations are quite cheaper. And this move would get us more in line with the targets that we had set forth where we've been underweight. And we'd also like to add more to fixed income to bring our overall fixed income exposure closer to the target. So none of this is meant to speculate in any way, but it's to take advantage of where we think we are in markets, to add a little bit more to international markets based on valuations, and also to de-risk the overall portfolio a little bit by adding to the fixed income universe, which we think is finally starting to look attractive.
Ashley, just a quick question. 2.5 is portfolio percentage points or 2.5% of the MSS?
2.5 portfolio percentage.
Okay, so you're taking 30% out of the value fund.
Correct. Correct.
Okay.
Yeah. So we would bring,
All right.
you know, it says 18% here. We take that down by 5%.
Yep.
So it'd be closer to 13%. We'd still have a little bit of an overweight to US value, but we'd be adding to the international equities and adding a little bit to fixed income. And here's another, you know, I just thought give a little bit more rationale for that. As you know, value significantly outperformed growth last year. So we still have a bias to value over growth, but the bias is less significant than it was because of the large outperformance of US value. However, we have a much higher preference for value in the international markets. We think that there's much more scope to catch up there. So when we're adding to the Vanguard, you're going to get a lot of value exposure in the international world, and we think there's probably more upside there going forward.
And the Vanguard rather than MFS International Value?
Yeah, we like the Vanguard. It's a low cost option, gives you broad exposure to the international markets, has a little bit higher emerging market exposure than MFS.
But not Russia.
Not Russia. No Russia.
No Russia.
We have no Russian holdings in the portfolio. Like, we should have started that way.
Quick question. Is there any correlation between US markets and how emerging markets perform? So say if the US goes into a recession, how have emerging markets historically performed?
Yeah, so a good question. You know, it really depends. So right now the story is that a lot of the things that we're doing here with the Fed raising rates is having a negative impact on economic fundamentals as well as corporate earnings. We're seeing a little bit of a reversal in the emerging markets where China's been shut down for a while. So the fact that they're reopening is actually really helping their economy. It's likely to positively impact earnings there. And it could have a spillover effect into some of the surrounding countries as well. So we think that some of the fundamentals, even though they're decelerating or going negative in the US or actually starting to reverse course in those markets. So depends on the scenario, but I think where we are today, we do think that, the international and especially the EM markets are starting to look more attractive. What's typically also been a headwind for emerging markets has been when we see higher interest rates.
Correct.
Okay, because a lot of that debt is priced in dollars. And, when you have a stronger dollar, it makes it more challenging there. But as we start to get to the end stage of rate hikes, which we think we're potentially very close, we could start to see better performance from those markets as well. So again, this is just a modest shift where we're getting closer to our targets. So we're not certainly loading up the truck and saying, let's go in those markets, but we definitely see some scope for positive fundamentals there. And when you combine that with more attractive valuations, we think now's a good time to start legging in further there.
Okay, yeah, thank you. That's great context.
Okay, so I'm just going to throw in one example is that higher interest rates hurt emerging markets more than a recession in this country. China being an example, if you followed any of the news last year that the Chinese real estate market had big problems. Okay, and if you saw Evergreen was one of the biggest developers in China, there were some theft issues within the company, which is not abnormal in China. But what really hurt the company the most is rates went up. They were rolling over debt, Chinese debt that was denominated in euro dollars. So as the interest rates went up, the cost of funding those developments went up tremendously. And they basically filed for bankruptcy in the Chinese version, which probably means the head of the company no longer exists. Okay, higher interest rates are going to impact emerging markets more than a recession in this country. Okay.
Got it. Thank you.
Okay.
Sure. So basically, as you go, that's pretty much the end of our report. As you go further in the report and you look at the municipal plan, the admin, and the OPEB, the returns are generally fairly similar across the board. The managers, as I mentioned, are all exactly the same. The OPEB today is slightly more conservative than the other three, and that led to some slight better performance last year overall, but still fairly similar. So David and Mark, I don't know if you want to add anything to that.
Yeah, the only thing I would add, Janet, correct me if I'm wrong on this one, but when Janet mentioned that any savings that results from the insurance, the self-insurance that the city keeps, not from the education side, but that money stays in the OPEB because it's a pass-through trust for the newer members, is that the town allocates so much money for self-insurance at the beginning of each year. Janet gives us a cash flow schedule of what may be needed, and any overage is maintained back into the fund. And the risk management has been so good between Lockton and Janet's crew that this portfolio has been able to grow dramatically over the past years that we've been working with the town. So it's worked out real well. It's one of the better funded, and John, you probably can quote it better than I can, one of the better funded OPEBs in Connecticut, because a lot of the towns and municipalities have not even funded their OPEB to this point. Do I have that one right, John?
You do, but I should send this to you, Mark. I took a look at it when a lot of the new committee members asked me about it, and there's a lot more towns around that are better funded on OPEB than they have been historically. So we're the third highest out of my peer group of 10
That's
towns.
pretty high.
Yeah, but before hardly anybody had any funding. So
right, but the other towns are now catching up. But this was started a long time ago.
Yeah,
at the time.
Right.
Didn't impact. I'm going to guess it didn't impact the town's budget as much as it is some of the other municipalities because they're late in the game. So.
Yeah, more likely.
Any questions on anything that we reviewed, markets, portfolio, managers? I guess you would need to vote on the.
We need to vote on the recommendations, right? So somebody want to make a motion to, and we can do them all together or just one at a time?
I think we do them. I would say do them both together.
Right, because I think they tie into each other. So.
Yeah, I recommend, I make a motion that we tell UBS to act on the recommendations they made about the change in investment portfolio allocation.
Second. Any discussion?
And John, just to clarify, this covers all three funds, right? The recommendation.
Yeah.
Yeah, right.
Well, it's 4 funds, right? Including OPEB.
Like 4, yeah.
I just asked one question. So reducing it by 2.5%, that's reducing the 17% by 5, so bringing the allocation to 12%, not
Right.
okay.
Yeah.
Thank you.
Okay, all those in favor then the recommendations, say aye.
Aye.
I
Anyone opposed? Okay. Recommendations. The motion carries.
Thank you.
Any other questions? Okay, yes, you guys.
Thank you very much.
Okay, thank
Great to see
you.
everyone.
Yeah, good to see you in person.
Yeah.
Nice to meet you in person.
Yeah,
Take care.
beautiful new place. Once I found it, anyway.
Yeah. Well,
It's all right.
I was in the wrong wing.
Ah,
Oh, you're upstairs?
Yeah, it was the east wing. I guess this is the west one.
I don't know.
I
It's
don't
upstairs,
know where we are,
downstairs,
but
right
that's-
side, upside.
This is actually north, but yeah.
Yeah, because it's the first next meeting, you don't show my buzz. I don't know when that's gonna be though.
Think positive. You know, we're near the end of rate hikes, so that is a positive. But you know, we do think we're going to see some earnings adjustments. We're going to see analyst expectations come down, but we'll see. I mean, the good news is you are starting to get paid on safer investments. So you can make money on cash now in your bank. You can make money on bonds. So there's some alternatives.
Yeah.
Not on the real rates though.
No.
Not yet. Not now. We'll see if Powell's successful.
Yeah.
Okay, next up we have Millman.
Yeah, you can, just in case anybody asks. Thanks, Ashley.
Yeah.
Take care,
Safe
everyone.
travels.
Yeah.
Ashley was going. That'd be good. The meeting message too.
You all set?
Do you have the presentation too?
I'm looking for it right now. I was just thinking that, so I didn't know if
Give
it
us
was
a
so.
second then.
so-
We'll
yeah,
put it up there in a minute.
Yeah, because my mailbox was too full, so after I sent it to you guys, I had to delete it, so now I have to recover it.
Ah,
Which is so much
and
fun
worse
with
than a
these
full mailbox.
emails. You think so? No, I'll come back in where my date was that I took it out, so I gotta go down.
Shannon, committee, is it okay if we sign off or you want to?
Yeah, you're all set. Yeah, you can go. Yeah.
Okay.
Thank you.
Have a good evening and a
Thank
good rest. Okay.
Good night.
Let's see where this change that I saw. Oh, this was a sent document. Would it be sent maybe? Possibly.
What was it named?
It was the
Lose Mitch.
pension valuation.
Could be.
So where, sorry. It was a search.
Still have a quorum though.
Quorum?
We still have a quorum, right, Jan?
Yep, we do. Because Mitch is gone, but we still have the other ones.
Clark's out of the room though.
Yeah. Yeah. Unless you can hear us from here.
Okay.
Yeah, hopefully we'll be back by the end.
Oh, saying thanks,
If
Jan.
you have a way for me to plug into my computer to show up on the screen, I could do that.
If you go into the Zoom link that I sent you, you can do it that way, but just hold on one second. Wait a second.
I'm having difficulty accessing your Wi-Fi for some reason, so I don't know if I'm gonna be able to do that. I can access it on my phone, but I cannot access it on my computer.
Let's see.
Yeah, I don't have it on my phone either.
Your Wi-Fi there for me.
Oh, here, I'll just go over here to.
Damn Wi-Fi.
Yeah, I tried that out in the hall. It gives me, oh,
Scroll all the way to the bottom of the page.
there we go. It's working now. Oh, wait a minute.
checkbox that says I accept. And then I'll get you in there. Now, should,
This one here?
not showing your internet is active though.
Let me try.
Oh, okay, good, we're there. Yep, okay, you should be able to close that window and pull up what you need.
Oh, just pull it up and it'll,
Yeah, you should, if you're, if.
or do I have to go to the Zoom?
You'll have to go into this.
To the meeting, right? Okay, so I need to get logged into the Outlook here.
Can you find, but I can't find it anymore.
No.
Nope. Yeah, it's just Mitch saying thank you. So I'm sorry, bring back the wrong one. I brought back the wrong one, but brought back his.
Click the all folders.
Yeah, I did.
That's all it gave you.
That's all it gave me. 'Cause I did for last week and I did this week.
Hmm.
Because it was Sunday I was doing this. I really gotta get a life. Those ordinance changes, the ordinance change. Nothing in there.
It's really weird. Why did it not restore?
But I'm wondering if it restored the one Mitch just responding to me. Because they had the same name on it. So that's why I was wondering. So yes.
Oh, okay.
I had to do it in 3 different ones. It's too big. It's huge. Restore.
Just a slight delay, we get technical difficulties wired out.
Throws them at the bottom.
Wait.
So there's that.
Recording in progress.
Click on the actual. Scroll down.
Is it coming up for them though? Or is it just
Not yet.
something?
I'm gonna do this.
Mhm. Not it.
Okay, I'm in the
Are
meeting.
you in the meeting?
I
I want this screen.
don't see any menu to share my screen though.
On the very bottom?
He won't have it yet. Pull him over from Bob.
Oh, he's in, okay,
Attendee.
he's in attendee, okay. Participants, let me pull you over. That's why you're not seeing it.
Join as a panelist.
Yep. And then you should have a toolbar at the bottom.
Okay, so.
Janet, have you gotten a report yet from them? Oh, you did, okay.
Last week, and I'm
Huh?
sending it to IT for them to upload it.
Oh, okay, yeah, no worries. Just didn't know if you got it.
He's gonna do it.
Yeah.
Preference, which plan you start with?
Well, police is the biggest. so-
Yeah, police is the only open biggest one. He's just-
We'll start with the police.
Thank you.
There we go.
There you go.
Okay, thanks.
Thank you, James.
My name's Kai Peterson. I'm an actuary with Milliman. And this is my first time meeting with you. I joined Milliman November of 2021. So I'm relatively new to the firm. I'm a fully credentialed actuary. I'm a fellow of the Society of Actuaries, enrolled actuary, member of the American Academy of Actuaries, and I also have my charter with the CFA Institute. And I've been doing consulting for over 25 years, almost exclusively with pension plans. And this is actually my second stint with Milliman. I was with Milliman a number of years ago, and I guess they just couldn't get rid of me. And, anyway, so but I'm really glad to be here. I'm prepared to go through, all three of the plans, ask questions as we go along. I don't know how much time do I have per plan? No time constraints? Okay.
Well, when 12 o'clock midnight is probably our
Midnight, okay. Well, we'll try not to keep you that long, unless you find this so riveting that you just want to walk away. So what I have for each plan is a 7-page summary of your valuation results. I don't know if I sent the full reports. I don't know if you have a chance to.
We haven't seen those
We're
yet.
putting those up on the website.
You put them up on the website,
Yeah.
okay. Well, this will contain a lot of the salient information from the full report. And then I did add one thing that we don't always add, but I added a page that's our long-term forecast to the summary too. So we're not just looking at where we are today, but kind of how things will evolve over time. I thought that would be helpful. So just to give you a little bit of an overview of the team now, Becky Seelman is the equity principal of the Heartland region, who oversees the public sector practice. And Heartland covers like the Northeast, kind of goes along the northern part of the United States over to Nebraska, basically is the way to think of it. So it's a pretty big geography, but most of the clients are kind of up in the Northeast here, and many public sector plans here in Connecticut. As I mentioned, I'm Kai Peterson. I manage the day-to-day work for you, and I've got a team of analysts and actuaries with many years of experience and many years with Milliman too. So you've got a good team backing this plan up. We're a strong firm in the public sector, and we have a lot of examples of our thought leadership. One example is something we call Dear Actuary, which is just kind of straightforward answers to common questions that many people might have about pension plans. We also do a public pension funding study where we update an annual update of the 100 largest public pension plans in the country. And then we also have a public pension funding index, Milliman Medical Index. That's not the purpose of this meeting, but we're very strong in the medical insurance as well. We're active in the community. An example of that is Becky Seelman and Jen Castellano participating in the Connecticut Public Pension Forum, where they gave a speech or presentation on managing contribution volatility. There's always that challenge of managing volatility, but trying to grow grow the pension fund, and what's the right level of risk to take to manage, balance out growth versus volatility. So then that's just an overview of kind of the company and your team and our activities in with public pension plans. And just to finish off with our mission up in the right-hand corner there, our mission is to serve our clients, protect the financial well-being and health of people everywhere. So that's what we do.
Okay.
It's not paging down. There we go. The other thing. Okay. So on this page, I'm summarizing the demographics of the plan population, the people in the system. And in the top left, there's a 5-year history of the membership. And the bottom part of the bar graphs, the lighter blue is the active members. The middle bar is members in pay status, and the top darker blue is terminated members. And what you'll notice there is plans go through life cycles, and they age and they mature. And what you'll see over time is migration from active members to terminated or members in pay status. And you're seeing a little of that. You're not seeing it as much as you may see it on the other plans, because when you're closed out, you have no people coming in.
Right.
But here you've got people coming into the population. So the active member population has stayed fairly constant. It's dipped a little from 2018 to 2022, but it stayed fairly level. But it's not unusual to see that with a plan that, over time it is maturing and it's doing what it's supposed to be doing. Members in pay status has gone up, and it looks like from my notes you had some new 6 new retirees, a couple of people got paid lump sums, and you had some new entrants. So net, you had a decrease of 1 because you did have some retirees slightly outweighing the new entrants.
I just ask a question on it. Yeah. So, it's actually more, so there's only, like, the pension for the police officers, everybody's in that, right?
Correct.
So we only have 54 officers.
Your admin staff are not in it. So like the dispatchers,
Right.
the admin, they're in the, they're not in, unless they've been here longer, and I don't think many of them have. Jen, correct me if I'm wrong, but they're just in the money that we put into a pension. They're not in a defined benefit like this anymore.
Thank you.
So some of those active members that retired, you're seeing them going into the increase in the numbers of the members in pay status. And then there was one death also, so you had 6 new retirees and 1 death, so net 5 increase from 79 to 84. Your terminated members, there's 4 total. 1 is due a vested benefit at retirement. The other 3 are not vested, but they would be entitled to a refund of their member contributions. And then lastly, there's in the kind of middle, on the right side, the middle box, that just summarizes your pay status individuals by service retirees, disabled retirees, and beneficiaries. So you've got a fairly typical mix of among that group as well. And then the bottom half of the page is your active population. The vertical axis is age in 5-year age buckets, and the horizontal axis is service in 5-year service buckets. So top left is youngest people, shortest service. Bottom right is oldest people, most service. Mm-hmm. So what will happen over time is, the people up in the top left will migrate down over the years to the bottom right. But as long as the plan stays open, you're always going to see people in the top left coming in as people go out. So it's just kind of a revolving process. So keep this in mind a little bit when we look at the other plans. You're going to see a different picture. But this is pretty typical of what we'd see for a plan of this type that's open. High level plan assets. The top left shows your annual performance or fiscal year performance over the last 5 years. You had 4 really strong years, and then we had this year through June 30th. Keep in mind it's June 30th end date for our measurement purposes. So tough year, but it followed 4 strong years, and you just kind of got to take the good with the bad. that's the picture you'll see pretty much for all four plans, because as your advisor said earlier, the strategies are fairly similar across the three plans. The chart on the right there, the green box, that's showing your asset reconciliation from July 1, 2021 to July 1, 2022. And again, because it was a poor year, the net investment income was down considerably at 9.2 million. The year kind of stung. One of the things that I like to look at on this particular reconciliation is I like to look at your net cash flows, just to get an idea of cash in, cash out. And by cash in, I mean basically contributions. Cash out, I mean benefit payments and administrative expenses. Because what I'm trying to get at is how much how hard are your assets going to have to work if there's a net deficit. So for this plan, the net cash flow is about negative 660,000, which is 1.2% of plan assets. So relatively speaking, the assets don't have to work as hard when you've got, good cash flow coming into the plan relative to the benefits. Over time, that could change as the plan matures. And what you'll see with plans that are closed is that becomes a much bigger percent of assets. And you have to watch it because you don't want to, you try to avoid the situation where assets have to be sold to cover cash flow at inopportune times. Right. And, the normal operation of a fund, hopefully just the turnover of the fund and cash flows from fixed income instruments, will cover any deficit. But at 1.2%, that's, I don't look at that and say, oh my God, that's a real problem. Then in the bottom part of the page, the double bars are the actuarial and market value of assets. We use, to help manage volatility, we smooth out assets, meaning we recognize 50% of the gains or losses every year over 5 years prospectively. So if you look at 2022, you'll see the dark green, the actual value of assets, is considerably higher than the market value. And the reason for that is that full 9.2 million that was lost on a market basis, we're only reflecting 20% of that in the actual value. So that gives you some mitigation against volatility.
But last year you didn't smooth. You made actuarial value equal to market.
Correct. We mark the market last year, but we will smooth going forward.
But we always smoothed in the past. Why'd you mark the market last year?
Well, typically what we do is we present different options. Mm-hmm. And that was one of the options that we presented.
Presented to the town?
In our meetings with. Okay. Yeah. And
okay.
So we laid out both kind of if they did actual value versus market value, tried to convey the kind of the risk.
They picked market because it gave them the lower answer for their budget. Just speculating. Now, one thing I noticed is you did mention that's a fairly material change in assumption, right? For your analysis, going from smooth to market last time and then back to smooth this time.
Well, it was a reset. So it's not unusual to do every once in a while to reset.
Yeah.
That method, yes.
Okay. Yeah. I guess the only question I would have is, I noticed you mentioned the change in assumption, but you didn't say anything about whether it was reasonable or not.
The assumption, well, first of all, it's a method, not an assumption, just to make a distinction.
Okay.
But it's not an uncommon practice to reset to market value and then smooth going forward.
Okay.
It's not something you would do every year.
Right.
But
you're not required under ASOP 41 to say if that change in method is reasonable, or 44 or 51 or whatever one you use.
ASOP, I think you're referring to ASOP 4.
Well, there's ASOP 4, there's 41, which is communications, there's 44 that talks about change in methods. So
we did disclose it.
You disclosed it was a change. You didn't talk about the reasonableness of it. That's the only reason why I'm asking.
In the report?
Yeah.
It's a fairly common move to make.
Okay. But I guess I'm an actuary too, so, but not a pension actuary. So I think if I changed an assumption that was that material, I would have talked about it, or method, whatever you want to call it. And I would have talked about it and said whether or not I thought it was reasonable.
Well, we wouldn't have proposed it if we thought it was unreasonable.
Okay.
And we laid out the options in our evaluation summary to you, and laid out the pros and cons.
To the town, not to me.
Yes.
Not to this committee, to the town.
To the town.
Yeah.
Yeah.
Okay.
Any more questions on that page, or? Okay.
I would just like to show some support for John's position. I've been watching this for 12 years. I've never seen that happen.
Or we changed the market value.
Yeah.
And then change back.
Right.
Yeah, but personally, I like market value better, but I understand why you would do smoothing so it doesn't bounce around as much. But I just get concerned where we flip from one side, one end to the extreme to the other.
Yeah. I mean, that's a fair, it's a fair observation. We laid out both options.
Right.
And it's,
Yeah, I understand what you did, and you can argue both of them are reasonable. I just get concerned about the flopping.
Yeah, well, and to the point. Yes.
I didn't mean.
Clark, you want to say something, or
when you lay out options, do you present pros and cons? Do you make your own recommendation?
We discuss the pros and cons.
But do you make a recommendation? What you would do if you were managing this fund?
Well,
your own pension fund, for example.
If I was managing a pension fund,
yeah,
I would not consider it unreasonable to make that change with the understanding that going forward, it was going to continue to be smooth.
Okay.
And then that's the premise here. This is now going to be smooth for the next 5 years.
Right.
But we don't know that. Well, we don't know that. The market could go up 35% next year, and they'll say we want market value.
That's not our intent.
I know that's not your intent, but
that would not be reasonable.
Well, why is it reasonable what they've done? But it's the town that did it, not the actuary presented.
Right.
The two different methods.
We went with
and
an
a town decided.
And there's
what to
other
do.
things too, John, when he's presenting to us, there's other factors
Yeah.
that change that influence that.
Yeah, I know. He lowered interest
Mortality
rate. He lowered,
tables.
yeah, he lowered interest
You lower
rate.
interest rate,
twice in a
put it
row.
all together, you've
Yeah.
got to go with what you consider a reasonable option.
Yeah, no, I'm just surprised that there wasn't any comment in the report about the reasonableness of doing that. That was my major comment.
Okay, fair enough. The comment was made earlier that you hadn't seen it in 12 years. I apologize. I don't know who said that, but were you referring to in this plan or in any?
I've been at 12 years, so I'm.
I think Clark mentioned it.
Clark mentioned it.
It's been, we haven't gone to market value as long as I've been involved in it, which was 2012, and Clark was involved in it before me, so.
Well, I think that gives you kind of a frame of reference for kind of how often we would necessarily do something like that.
Yeah, well, and it's not you, it's the town.
Yeah, I mean, understood.
Yeah. But I've noticed that West Hartford's doing the same thing, I think. I saw a presentation that Becky had done, and they talked about, they went to market value 2021 and then went back, proposing to go back to smoothing in 2022.
Right. And like I said, it's intended to be, a one-time thing, not flipping back and forth, reacting to the markets.
Okay.
Well, I guess that's a good question. Have other municipalities that they've taken that same approach? It sounds like at least West Hartford has.
Well, like I said, it's not unusual. And I'm not involved in that particular plan, so I can't speak to what they did, but I mean, it's kind of at least anecdotal evidence that it does happen.
Yeah. So I only looked at West Hartford because they
issued municipal bonds to
cover
fully
it.
fund their pension.
Right.
And they put all the money in 621, which probably wasn't the best time to put money in the market. So they put $300 million into the market on 621.
And it tanked.
But it didn't tank because they smoothed in 622.
It didn't tank on paper.
Right.
Yeah.
It didn't tank in the actual assumptions, the actual market value of the assets tanked.
Okay, so switching from assets, well, actually talk a little bit more about assets and assumptions going forward, because this is one of the big topics on many pension plans. And this is just our view on the capital markets as of June 30th, 2022 for your portfolio. And for your target mix, that graph in the top right shows your asset classes, and the size of the bubble indicates the percentage of the portfolio that's invested in that asset class, and then it's positioned on the graph based on its riskiness in terms of standard deviation and the expected returns. So the vertical is expected returns, horizontal is riskiness. So the bubbles that are more the green color, those are your fixed income assets. The bluer ones are your various equity assets. And then the smaller black dot in the middle is your entire portfolio. So on average, over the longer term, in the bottom part of the page, we see over time how the range of returns evolves over time, and over the long term, 30 years in this case, the median return is 6.7%.
Okay, were you here when UBS did their recommendations? Because it'll change this a little bit, but it shouldn't be material, right?
I wasn't in.
Okay, well, what they decided to do is move money out of large cap equity to non-US equity.
Okay.
Which will raise the return and also raise volatility, but also move some into US fixed income, which would lower the volatility and lower the return. So overall, I don't think it would affect your number that much. But
Actually, yeah, I was here at that part.
Okay.
Yeah, I mean, one of the things that we're seeing now is we are seeing that kind of a move from equities to fixed income because you have higher yields right now, but also the concern in the past was, and I think they alluded to this too when they're talking about the duration of their bond portfolios. In the past, we were worried about interest rates going up,
right,
and positioning portfolios for that.
Yeah.
Now you've got sort of the alternative set of possibilities where it's more likely that interest rates will stay the same or drop,
right,
compared to last year.
Yeah.
So that makes a lot of sense. But that possibility, along with the fact that equities have been at the time we measured our capital market assumptions, were kind of underpriced. Our expected return for your portfolio this year at 6.7% is maybe 50 basis points higher than our model last year.
Okay.
That said, we don't necessarily recommend that people react to a one-year change in kind of capital market outlooks.
Oh, yeah.
Don't go necessarily dramatically changing your assumption, depending on what it is. So that's our perspective on your portfolio and your asset allocation. On this page, we're going to look at the plan's liabilities and the funded status. And top left is the liabilities, and they're growing over time, partly because of just the evolution of the plan and the life cycle of the plan, but also because you've had some assumption changes in there. dropping your interest rate pretty substantially. I think in 2018 and 2019, it was 6.875%, and you've steadily dropped it to this year. We're showing results at 6.125%, which is considerably lower than what our model would say, and probably even lower than what our model would have said last year, probably. So that has the effect of when you just change your discount rate, by the virtue of that, just remeasuring it, the liability goes up because you're assuming basically a lower rate of return on your portfolio.
You know how much of the increase was due to that change, the 1/8 of a point change in investment rate?
I think it's in your report.
Oh, it'll be in the report? Oh, yeah, it usually is, right? Where you reconcile what's causing the change in liability. Right?
Yeah.
Okay. Yeah, we haven't seen the report yet, but.
Yeah.
Okay, yeah, perfect, thanks. I didn't know if you knew off the top of your head.
Okay, thank you, I appreciate that. So that's basically kind of the liability picture. On the right, that's just a breakdown of your liabilities. So it's basically the liabilities on the left, but it's breaking them out by the terminated members in pay status, and active members. So if you look at the middle bar, that's probably the most interesting one. Back in 2018, your members in pay status were 55% of the total liability, and now they're 65% of the total liability. So
that's because of additional retirees, right?
Exactly.
Yeah.
We had 6 in like a 2-month period.
Yeah. Did they retire and go someplace else?
Some did,
Yeah.
some just retired.
Yeah, well, because a lot, it seems like there's a lot of poaching of,
Yeah.
you know,
Yeah, and
police departments from
once you put the years
Yeah.
in, it's like, why not? I can go get another pension somewhere. I'm still young enough.
It's 20 when they're eligible.
I believe it's 25 now.
25 with the new ones.
Yeah, it depends on when you were hired.
Yeah, it used to be 20, it's moved to 25.
Yeah. 15, 25.
So that's your liabilities and the breakdown of the liabilities. The bottom left is your unfunded liability. So this is measuring your accrued liability versus the actuarial value of assets. And, you know, it's bounced around a little bit. It kind of, in 2018-19, it grew a little when we started to change assumptions. Investment performance kind of took over after that and lowered the unfunded liability through 2021, and then this year, because of the markets, the unfunded liability increased.
Well, but if we were still using market value, the unfunded liability would be 34 million, right? Not the 23.3.
Correct.
Okay.
Yeah. Considerably more.
A little more if you got an extra 10.7 million when I hand out.
Yeah.
What would that have done? What would that have done to the ratio on the right? It's like definitely still better off than 18, but it did take a little slack.
I don't think we're better than 18. 10.6 million divided by 89 million.
I'm just talking about the funded ratio here. If
Yeah,
I'm reading that right.
it would be about 12% lower, I think.
Okay, so yeah, so it'd be, yeah.
Yeah,
64.
62.
So we've started to discuss the last graph on the page, your funded ratio, which in 2018 was 66%. And now in 2022, it's 73.8, despite lowering your interest rate over time. So that's a positive. And, you know, 74% funding in the aftermath of the downturn we just experienced as of June 30th, 2022 is, you know, a pretty reasonable funded ratio. I would characterize it as good, but not great. There are plans that are more challenged, for sure.
There are plans that are less. Yeah.
Plans that are less.
Like Bristol.
There's a, you know, there's sort of a kind of an art to it. And what I've observed over time is plans that make, healthy contributions based on reasonable assumptions and are just consistent are the funds that do the best. Funds that get in trouble are funds that they maybe for whatever reason don't make their contributions that they should make, or they're overly aggressive in their assumptions, and then they kind of get behind the 8 ball, and then you're trying to play catch up.
Yeah.
And then you got to take more risk or increase contributions, and so.
Sort of like the state of Connecticut.
I'm sorry, what?
Sort of like the state of Connecticut.
It didn't fund the pensions for a lot of years.
Yeah, exactly.
Yeah, well,
Poor decisions on where to fund it.
it's down to decisions about where you spend your money
Yeah.
at the state level, and sometimes those decisions don't work in favor of the pension funds. But eventually it has to be remediated somehow. So the next page is your actuarially determined contribution. And this is sort of the end product of our valuations, what we recommend for contributions. And you've seen the benefits over the last for the last 5 years of the improving strong performance. And then for the fiscal year 2023-24 contribution, which is what we measure as of July 1, 2022, it went up because of the market performance primarily. And then in the lower half of the page, we just show how it's broken out. And there's three components to your actuarially determined contribution. One is your normal cost, which is the value of the benefits that have been earned for the year. It's not the dollar amount, it's the actual value of those. So it's like how much we need to invest to pay those benefits. And then the past service cost is the accumulation of those past normal costs. They accumulate, and then you compare that to your assets, kind of what you should have put in compared to your assets, and then you amortize that unfunded amount like a mortgage over a period of time. And then there is, because the calculation is done as of July 1, 2022, for example, for fiscal year 23 to 24, there's a year of interest out on top of that. So that's what that interest slice is.
So that's based on the 6 1/8%.
Yes. Whatever your assumption was. Yeah, exactly.
Okay. I don't know if this has anything to do with this, but with the funded ratio, at what point do creditors at what point do municipalities start to get concerned? At what level? Like it's down, like where should we be? I know ideally you'd say 100, but that's not accurate.
Yeah. Huh? That is accurate. That's where we should be, but it's not realistic.
Very few. Very few. So I mean, what's accepted, I guess? Or is it standard?
Well, there isn't really
There isn't.
kind of a bright line benchmark or anything that I'm.
It would feel to me like somewhere in the 80-ish percentage, but.
Well, some intuitively that makes some sense. If you kind of look over in the private sector, there are significant benchmarks that are stipulated by the IRS for certain things. And one of those key benchmarks is being 80% funded. Now, the measure of funding is very different. In that case, they use just a high quality bond interest rate. So, it's nothing like, over 6%, although.
Yeah, well, it's a lot less discounted than this, yeah.
Yeah, so a year or so ago, if you looked at corporate disclosures, they might have been disclosing at, say, 2.25% discount rate. Now it's more like this year, a year later, we've seen more in the over 5% discount rate. So their liabilities go all over the place because they're measuring them based on interest rates, not on long-term rates of return. So.
No, just
But-
to give you a feel, West Hartford last year, before they infused all the money, we're at 40%. And I think their bond rating was similar to ours,
And you mentioned Bristol, what are they?
156.
150?
ESPN.
Oh, okay.
ESPN just kept on building and they kept on getting the money and they just dumped it into pensions. But they have a pretty high assumption on return. Their returns assumption's like 8, which
Oh,
I don't
really?
think is realistic, yeah. Because they have a bunch of money in hedge funds and they think it's gonna be better. But when you have all that extra money, I guess you could do that. I don't know why you would, but
But I guess you can take the risk. It's probably a pretty high standard deviation.
But I haven't heard anything about, and maybe you know better, you haven't heard anything about anybody changing our bond rating.
No.
And usually
And
it's
you know,
been
when they go
positive.
out, when they go out to bond next time,
Yeah,
they may have increased how much they're funded, but now they're gonna say, you have to go out to bond? You
Yeah.
have to go out to bond to make up your pension fund.
yeah. Well, they
Usually-
bonded 300 million,
Yeah,
so it's
you're
like,
sitting back,
yeah,
so that's not gonna look good the next time they
Yeah,
have to go
right.
out to
They
bond.
go
So
out,
we
yeah.
have very low
yeah.
bond out for bonded funds.
Yeah, just another point too, Bill. Rhode Island, when they redid their state pensions, they have a rule that if a municipality isn't 80% funded, they have to come up with a plan to get to 80% funded.
So
Of course, my town and that I have a second home in Rhode Island just hired a new actuary who changed the assumptions. So they went from 60% funded to 80% funded by hiring a new actuary.
That works.
Well, not for me as a resident, but yeah.
Right,
To be honest, on other rating calls I've gone on, not once have they brought up our pension funding.
Oh, no,
Nope.
never.
Nope.
No,
they
because we've
don't.
been funding and we're probably higher on OPEB
We've
than
always
most
been,
other
as long
towns.
as you're making the actual
Yeah,
contribution, they've never questioned it. It won't right now.
Yeah.
They want to see that our revenue base is
Yeah, it's
stable
increasing, yeah.
and is increasing.
Grand list will help with that.
Yes.
I mean, and there's a number, the example you gave is just one of states where they've had to legislate pension funding. Illinois teachers is another
Oh,
one.
yeah.
They just, didn't make contributions for many years. And so they've got a plan. It's not, by actuarial standards, it's probably not as sound as it should be, but it's
It's a plan.
a plan.
We didn't have a good plan, but it's a plan.
It's better than no plan.
Better than no plan, exactly. Yeah.
Maybe.
Hope isn't a strategy. So any questions on this page? So here's the numbers. What we've got here is your results from last year, the 2021 valuation, and the results this year, the 2022 valuation. And we made 2 changes this year over last year that we're reflecting here. One was we changed the mortality assumption. There's an underlying mortality table that's sort of a public sector standard table. That was, as an actuary, you'd appreciate this. They did a very large experience study where they looked at the pension systems in like 35 states, and there was 46 million units of exposure. And they came up with public sector specific mortality tables because the public sector was saying the ones you're using that are based on kind of annuity plan experience aren't applicable to the public sector. So there's a general table, there's safety table, and they're weighted by salaries or benefits or just head counts, which is maybe more detail than you want to know, but your underlying table is the kind of the standard for public sector plans. And for the police, we use the safety table. Now, on top of that is an improvement scale, because we hear all the time about people are living longer. So every year or so, the Society of Actuaries comes out with a new scale for improving mortality over time. And what that basically does is it says that somebody, it basically gives probabilities that people die, basically. And what it allows for is the idea that somebody who's 65 a year from now will have a different probability of dying than somebody who's 65 20 years from now because of medical technology improvements, et cetera. So we updated the mortality improvement scale to MP 2021, which was published October of last year from the MP 2019 table. There will not be an MP 2022 table. They did not issue one this year. What we've seen with these improvements recently, they have not had a huge impact. And some of it's been a little bit counterintuitive because you hear a lot about life expectancy increasing, but the rate at which life expectancy is improving is decreasing because you can only get so much out of a technology like, cure. The more things you cure, the less chance you have or opportunity for improvement, right? And on top of that, you've got, COVID, for example. How's that going to affect mortality? Well, the short-term impacts were clear.
Large, yeah.
The long-term impacts, it's hard to know at this point.
Yeah.
But there's other kind of public health issues that we deal with that are having an impact. Obesity, for example, counteracts some of the improvements. Disimprovements, I guess, would be that. So that's a lot to talk, a lot of it long explanation, but I did want you to understand kind of what we do with respect to the mortality assumption, because it gets a lot of discussion, even though it doesn't really year over year, unless you change tables. When we changed the table, underlying table, that had a bigger impact. When you're just changing the scale, at least so far, it hasn't kind of moved the needle. What moved the needle more was, and generally, is changing your interest rate assumption. And what we endeavored to do this year is lay out assumptions that, we thought were realistic, but also kind of took into consideration what your contribution was last year, versus this year, so that there aren't huge shocks. So those were the assumption changes. The other thing that we did is, I mentioned earlier that you have a amortization of your unfunded liability. Last year, your amortization period was 11 years. We increased it to 13 years. Couple reasons. One was just to mitigate some of the increase over last year, but still being reasonable. And you'll see that your other two plans are at 13 years.
They went down from 14.
They went down from 14 to 13.
Now they're all 13.
Yeah.
13, but the other one, don't we just fund 90% of actual determined contribution or something, or 90% unfunded liability?
Whatever the actuarial determined contribution is,
Okay.
we fund the full amount.
All right.
So yeah, the other plans are decreasing. We increased this to 13, not with the idea that we're going to keep increasing it, just to bring them all kind of in sync. And the idea is to lower that every year. We'll start to look at it closely at 10 years, because when you drop below 10 years, your contributions can get volatile.
Okay.
Think about what happens if you have a 1-year amortization year for your unfunded, and then you have a market downturn. Even though we smooth it,
Right.
you got 1 year to pay it off. So practically speaking, 10 years sort of is where we kind of maybe say, no more. But in my experience, funds that have had amortization periods in the 10, 12, they're doing pretty well, assuming they've got their other assumptions reasonable and they're making their contributions. So there are some systems that I've observed, not here in Connecticut, that have infinite amortization periods because they have a contribution rate that's so low. They set a fixed contribution, And it's so low, when you back into the amortization period that would be required to get to that, it's not, there is none. In other words,
Forever.
it's forever, because their contribution is so low, they're never gonna get there.
Ah, okay.
I've seen a number of those in Texas, for example. So that's could be a problem down the road.
And there's no thought about any of the union members contributing more or anything to that. That's on discussion or anything.
Those
That
for what?
contributing more to the pension.
For the PD, because that's the only
Right.
open one. No.
No, okay.
Wow.
So that is the police fund. Like another 200,000. Yeah, I'm sorry. I didn't even, I explained what we did, but I didn't really. Yeah, so the actually determined contribution went from 3,080,000 to 3,244,000.
That's combined, right? The town and employees.
No, that's our contribution. That's us. That's just the town.
Okay.
That takes into consideration how much the PD are contributing.
You look up a few lines, you see the expected employee contributions.
Yeah.
We net out about 637,000 for 2022.
Tim, can I ask a question?
Yeah. So,
Mr. Peterson.
Yeah.
When you talked about updating the mortality assumptions, you said the impact was not as great as lowering the discount rate, but can you give me some sense of what the impact was?
I unfortunately don't have that in front of me.
Okay.
If it's in the report.
It's in the report and
If
it's in
if
the
it's
original summary that I sent to you.
Okay.
Yep. So Clark, I have IT. I sent over the actuary reports to IT to have them post them on the website because I can't email them to you guys. They're too large. And I'm hoping in the next couple of days they'll be up. I'll send you guys an email when they tell me they give you, okay, they did it.
Okay.
And
No,
Clark,
I just want to say, yes.
I was just gonna say, if you look at the executive summary, they lay out the changes in assumptions and the impact.
Okay. I
So
haven't had a chance to review everything.
Yeah, if you look at last year's report, you can see it in there.
Okay.
And if it's not enough, I'm sorry, go ahead.
I just want to say that I'm glad to see that you've done that, because we were working years ago with mortality rates, I believe, that were published in 2010, or no, 2000.
Yes. Yeah, so you're using the 210, up 210 table, the underlying table, which is, the standard for the time being until they go out and do another major study. And then we are updating it for mortality improvements.
Yeah, no, that's a big improvement.
Yeah,
Thank you.
Nobody that would look at that would, it wouldn't raise any eyebrows. I mean, when I look at your methods and assumptions now, you're not unrealistic in your interest rate assumption. Your mortality is current. Your amortization approach, even at 13 years, is relatively conservative. There's another state that issues or requires their systems to report every year on a uniform set of assumptions and methods. And I think their amortization period that they're required to report on now is like 17 years. And it's been gradually going down, and it'll probably continue to go down. But you're, at 13 years, you're in a pretty reasonable place. So I think your methods and assumptions are there's nothing here that we would, would be uncomfortable about.
I'm glad to hear that. I used to lose sleep over the antiquated mortality tables we've been using.
Yeah, well, I think, these are, as good as we can do for now for the public sector.
Okay,
But they did change other pension mortality tables, right? Non-public sector to 2020s, didn't they?
Yeah, they actually update in the private sector, they update the table that you use for the funding calculations every year.
Okay.
There's, and it's got its own projection scale.
Yep.
And then for for accounting for companies, when they're issuing their financial statements, there's a set of measurements that you do for those. And they're using what's called the PRI 2012 table, which is sort of the counterpart to the Pub 210 table.
Okay.
But the auditors will always, well, not always, but many times expect the improvement scale to be the MP 2021 table and update that every year. So the people that are kind of overseeing that are making sure that we do that. And in our own profession, the 2021 table is sort of the expectation, unless you do an experience study or you collect the experience of your own plan, and it suggests something other than that. Okay, this plan is way too small.
Right.
So that's the police plan, do you have a preference which plan to go over next?
Well, maybe. I would think most of it's gonna be the same. I guess I would just suggest maybe doing the municipal plan because it's the bigger unfunded liability and it's a closed plan, so you can see it going down over time. So people who haven't been on a committee before can see that.
Yeah, the administrative plan.
Yeah, it's smaller.
Literally
So
has
those three people
so
left, right?
tiny.
Yeah.
Yeah, there's what, 30 some people?
When you know who the people are in the age service diagram, that's a small plan.
Yeah, right.
And just.
That one.
That one shot. In the three,
on the street.
in the plan, the three we just lost.
So
Which plan, the three that
we'll
in
skip
February that we
the
lost?
first page and look at the demographics. And to your point of this being a closed plan, if you look at the top left and look at the active members, 5 years ago there were 85, now there are 50.
It's not showing up on the screen, I don't get it.
Oh, sorry about that.
Is it
Yeah, still sharing your other page, so you gotta tell
NEW?
to share
Which
that
one
one.
is it?
Okay, so I guess I have to,
Then just hit share and then ask it to share that page.
I apologize. Okay, so which one it is?
And I'm not being morbid when I say this, but literally, we went to do pension in end of February and there were 3 people who passed away
Oh, really?
in that time period. It's just.
So
that
it's the
time of year.
NEA?
But you can still have.
I'm sorry, what?
Survivor
NEA
benefits,
one?
right?
NEW.
Those three?
I don't think, did
No,
it?
they didn't have, like, their spouse died before that.
Oh,
Yeah,
okay.
yeah, some of these pension, the plans are starting to, I was surprised, that's the highest, yeah.
Oh,
Wow.
There'll be a lot of deaths on the paper this weekend. There will be between 95
I'm not to
and
be morbid, not to
102.
be
Yeah.
morbid, but yeah, it wasn't.
My aunt that was 98 just died 2 days ago.
Let's do that.
She had an incredible life.
Yeah, 98 years is,
96, she used to break out of the assisted living and hop in a van and go shopping with her buddies down at the mall. It's buckets, yeah.
It's
Her
just-
son would call the assisted living. They'd go, we don't know where she is. Then she'd show back up at like 6 o'clock at night for dinner.
There you go, that's the life.
I guess when you're
shows up sober.
when you're that age, you probably don't really care.
Yeah.
Yeah, right, like elders.
Yeah.
Anyway, you have everything on the screen now? Okay. Yeah. So, going back to the top left, the blue bars on the bottom part of the bar graph, the active members have declined from 85 5 years ago to 50. Exactly what we would expect. Members in pay status increased from 178 to 194. And we had, I'm looking at the wrong one.
Let me ask another good, what do these folks have now, the people that are not in a pension?
Okay,
Is,
yeah, so the
But with a
town.
match
contributes-
for the first
yeah, well, I
6%
mean,
or?
so is it like 100% to 5? What what's the town match?
So the town gives 9 and was it 4.5, and the employee puts in 4.5.
Oh, so you get 200% matched to
First 4.5%, sweet.
But it's not a defined benefit.
I know,
I,
I know.
I missed the defined benefit.
Yeah.
Yeah, it's still a lot of free money.
Yeah.
Depends on what the salaries are, how free it is, right? Got to balance everything, but it's good money, yeah.
So just in terms of the ins and outs of the population, you had 7 new retirees and 1 death from active. And then you had obviously 7. So 7 retirees increased by 7. And then there were 4 deaths. And there's a beneficiary in there too, so it's net change of 4. The terminated vested employees, you've got 4 individuals who are entitled to a benefit of retirement. You don't have any individuals who you might want to pay out the refunded contributions. And then the bottom half of the page is your age service diagram. And what's obvious here is the left half of the graph is blank because it's closed plan. No new people coming in, everything's moving down to the right. The asset performance, pretty much the same story. I don't know, there's a whole lot to say about the returns and the kind of the market value, actuarial value discussion. I would want to point out on the reconciliation, I talked before about the cash flow and the percentage of assets that would be needed to cover the difference between the contributions and the benefits. And in the police plan, it was 1.2% assets. In this plan, it's 3.2% assets. So you've got to look, which not surprising given you've got a maturing plan. You don't have as much coming in the way of contributions. You got benefits going out. And, 3% is a little bit more of a challenge than 1.2%.
Right.
And that's probably going to continue.
Get worse, right?
Yeah.
Yeah.
So
Hey, Tim.
the investments over time are gonna have to work harder.
There's no.
Tim, can I make one more observation or one more question?
Sure, go ahead.
The 6.25% expected rate of return is much more realistic, obviously, and I'm happy to see that. That's still higher than what our historical returns have been.
Well, but they did drop it another 1/8 of a point. This was based on last year.
Correct.
At 7/1/2022, they dropped it to 6.125.
Okay, all right. Well, we're heading in the right direction. That's
Yeah,
fine.
and if you look at page 3 of their diagram, they're saying based on our portfolio that, that's not unreasonable for the next 5 years, 10, whatever. The average expected is between 6.1 and 6.7, depending on how many years you go out.
30 years. The
Yeah.
far right is 30 years.
Yeah. Well, I'm just saying how comfortable you feel going out that far, rather than some people would say, well, let me look at the 5-year return because I know you're talking about long-term retention, but I can't predict tomorrow, so I'm not sure who can predict 30 years.
That's when you talk to investment advisors and they talk about capital market assumptions, oftentimes they're talking about 3 years, 5 years, maybe 10 years. It's hard to find capital market assumptions that go out 30 years for that very reason.
Oh, yeah.
So it's a little bit of art, a little bit of science. I mean, the one place you can get some long-term assumptions is Social Security Trustees report. They go out a lot. They have a kind of a optimistic, pessimistic, and best estimate assumption for inflation, for example, which I think is a pretty good place to go to look for something like that, because at least they make an attempt at a long-term inflation assumption, which at least before last year was long-term, it was like 3%. So the last 15, 20 years have been below the historical 100-year average. But anyway, I think, again, at 6.125%, I think that's a pretty decent place to be. I don't know if your advisors gave you their long-term assumption.
They do every once in a while. They didn't do it today, but they do.
Yeah.
Okay.
And they're depending on when it is, it's between like 6 and 6.7 or something, I think.
Yeah, okay. Well, it's certainly higher than it was last year, many models. Anyway, so that's your kind of your asset picture. We'll skip this page because it's basically identical to the same thing. The story here is pretty similar. Your liabilities are growing. There are people earning benefits still, even though there are not people coming into the plan. The percentage of retirees, percentage of liability represented by retirees has grown from 55% 5 years ago to 65%. So again, what you would see in a maturing plan. The accrued liability has bounced around again or unfunded accrued liability, excuse me, has bounced around between 2018 and 2022, again, for the same reasons, some assumption changes, and then just market volatility. It was smoothed out for the most part. Then your funded ratio in the bottom right is it's kind of a mirror image of the unfunded liability. Unfunded liability goes up, funded ratio goes down. And you're at 56.7%, which is not great, but at least you have reasonable assumptions. And
it's going to be kind of scary 15 years from now, and there's nobody in the plan anymore. So no employee contributions anymore.
You just amortize to infinity.
Well, we have. I will show you in a few minutes. We do have. They're not in the handouts, but they're in this document. We have I put our forecast in there. That's in our evaluation report, so I can show you that. You can get an idea of what it's going to take for this plan to get to 100% funded, if all our assumptions are met. So here again, your actually determined contributions, bouncing up and down, kind of the same kind of dynamic as with the unfunded liability, because if you look at the bottom of the page, that's sort of what's driving your volatility, is the amortization of that unfunded liability piece up and down. The normal cost is, at least visually there, is staying pretty consistent. You get a little more volatility in the past service cost amortization. So in terms of the numbers, we made the same method and assumption changes as for the police. The contribution went from 2.3 million last year to almost 2.6 million this year. Due to assumption changes, and the amortization period dropped from 14 years to 13. And we will continue to drop that at least down to 10. That is something that we use, though, to manage costs. It's a lever for that, to mitigate volatility a little bit. There's no hard and fast rule that you have to go 14, 13, 12, 11. That's the general trajectory you want to be on. But you could go 14, 13, 14, 13, 12, 11, 12. You want to be going directionally that way, but not. It doesn't have to be a straight line down to that ultimate target.
So just so that's about another, in aggregate, like 600,000 more to pension contributions. I'm doing the math. Like in all three of the plans. You're like,
well, you got
160, another 300. I'm not doing math, right? So it's like.
So the administrative, which we haven't gone over yet, but that was. Administrative was 30. Yeah, so you got 33, and you got about 200. 275.
So 300, so like almost 460.
Any questions on this page? So how do you get out of that 3% range? Well, this is our forecast from the report. And you can see the left part of this, the first column is your accrued liability and how that's growing over time. That's compared to your actual value of assets, your unfunded liability, and your funded ratio next to that. So you'll see that the funded ratio is increasing from 56% and it gets to 100% in 2035.
But our town contributions, I can't see the numbers go from 2.6 to 4 point something
2.6 to about 4.5
in the next 14 years.
Now, one thing I
There
do
goes
want to
my
point
taxes.
out is, so
Yeah, right, man.
this
All
is-
of Texas.
mathematically, this is how you get there.
Right.
Okay. Now, in this forecast, even though you wouldn't do this, this forecast assumes that your amortization period goes to 1.
Right.
But realistically, you might stop it at a 10-year amortization. Or some.
But a closed plan eventually, I guess you could still amortize it even if people are collecting, right?
Yeah.
Yeah. You're not gonna get any more contribution from them, but the town can, but the later contribution.
Does this assume, like, are there rates of increase to the pension benefit? Yeah.
Yeah.
Not to this one, I don't believe so.
No, not
No.
to,
It's fixed then. Wow.
yeah. Yeah, there's not a,
Yeah, there's no
this plan
COLA.
does not have the COLA.
I don't get none.
One of my pension plan, my Aetna pension plans that way, I don't get COLA, but. Oh, yes, I do. I do get a COLA, but they actually went down 1 year. Actually, it's my Deloitte pension plan. I don't get a COLA.
Social Security, like, went up like 8%.
I know.
I don't know if that was.
We won't have that for these closed ones now.
No, not in the formula. You know, decisions like that when you don't have it built into the formula are on more of an ad hoc basis. So you can get there.
Can we afford to get there, I guess is the question.
If we have ESPN moving, we're all set.
Huh?
If we have ESPN moving, we'll be all
Yeah.
set.
Exactly.
We just need to discover oil, that's all we need to do.
Yeah. Okay, we got all these apartments coming in, we should be golden.
Drill for oil.
So that is, that's your municipal plan. Any other?
No.
Okay, we can switch to the administrative plan.
And Bill, you were asking, the total increase of all three plans combined is 470,000. That's split between the Board of Ed on 2 of the plans and the town.
That's cheers.
That's a coming
Contribution,
budget.
okay.
Yeah,
Yeah,
that's the
compared to
that's
last
the
year.
that's the budget that you'll see in front of the council.
From that's this year's budget right now.
Okay, we've got administration up there. Okay, we will not spend any time on this page. And you're gonna see a similar picture here for this plan as for the municipal plan, just smaller in scale. Your active population, well, actually did not change. It's gone from 6 to 3 over the last 5 years. It did not change year over year. And let's see here. Just basically no change. Your terminated invested, 1 lump sum got paid out, and your retirees, actually, I'm going to have to plug in my computer here. I'm about to lose my, your retirees stayed about the same. There was 1 death, but there was a beneficiary.
Well, how close are you to finishing up? Because I think, like the patterns. I don't know.
Yeah.
Just give me like 1 second here to plug in. I'm about to get a warning.
We'll find out.
Okay, so yeah, down at the bottom, your active members. Like I said before, you probably know, you know who they are. It's a small group, and it's exactly what you'd expect to see from a closed group. Now, the thing I want to point out on this page is the amount of work that the assets have to do to cover the shortfall. 9.8% of assets. So it went from police 1.2, municipal 3.2, this plan 9.8. So the assets are having to work pretty hard to cover that difference. No additional information here. You know, really not a whole lot to say here. The basic pattern is the same. Your fund, the funded ratio is fairly low at 43.8%. You're seeing, you know, contributions rise pretty significantly over time. And year over year, your ADC went from 720,000 to 753. Same assumption changes, same amortization period change. So what is it going to take to get this plan 100% funded? It's going to take a fair amount of money. And it's going to kind of grow slowly. It's interesting, it actually decreases a little bit. The funded ratio, and then it pretty rapidly escalates from 2028 to 2035. It goes from 41% to 100% if the money is put in.
Contributions go to what? What's the last time contribution?
Well, in 2034, the last one before before it gets up to 100% funded, it's 1.2 million.
Yeah. Okay, cool.
So it's not an inexpensive proposition.
Leaving an amortization at 13 years. Till the last guy dies. Okay, thanks.
So that's it.
Thank you.
Thank you.
And Jenny, let us know when it gets up on the website. Okay. Couple days, said.
Send over the work.
We'll see you next year, or typically we visit you once a year, unlike the investment folks who are here every quarter.
Every quarter, right?
Yeah. Unless we do any kind of special studies for you that you'd want us to present to you, but typically it's every year.
Thanks.
Yeah, thanks.
You're welcome.
Okay, moving to old business, we have the ordinance change recommendations. Do we still have a quorum?
Yes, you do. I've got Dave and Clark and Anthony still.
Awesome.
Names are still hanging out there.
Hopefully they're still there. Only one we
Mitch's
see is
name-
Clark.
Mitch's name disappeared on me, so.
Yeah, I'm here.
We're still here.
Okay, cool.
Thank you, guys.
We were waiting for all your questions.
John, you gave enough for the whole group.
Yeah. They're trying to kick me under the table, get me to shut up,
Nah,
but I can't reach
His legs
that far.
Yeah, it may, we're posting 2 seats apart. I don't know what this is here. Okay, so we have the recommendations in front of us, the 2.5 pages. Do we have them on the screen? Can we put them on the screen?
Don't know that I can get him a string. Oh, you're really asking me to
Sorry.
try this one, huh?
So the changes marked it anyways?
No, I took off all that red highlighting because I know
Yeah,
you didn't like it last time. I'll let John talk about the changes and I'll try to get up on the screen if that helps any. Let me just see.
Well, I talked about the changes last time. Well, I made all the changes that you guys suggested. So the main thing in this whole thing is that we added functions for employee pension benefits, which we never had before.
The only thing I would just add when we're doing it, in some places it says the town council, in places it says the council. It should be consistent.
Oh, yeah, okay.
Only because it says, I saw it where it says the chairperson, which is how I got this august job. It says council member, it should say town council member, because it says town, majority of the town council on the other side.
Okay.
Just to be consistent, I think we found that with another document I was looking at, sometimes it was capitalized, sometimes it wasn't capitalized, sometimes it was added, just made it simple.
Even under terms of members, because there's a thing that says terms of the council members and the Board of Education members.
But I think it should be town council. I don't know if there's any other council, but it should be consistent, I think.
Okay.
Yeah, it wasn't.
Thank you, Joy. It
It
wasn't
wasn't
originally,
originally,
yeah.
but yeah, then that's.
For fixing it, we might as well fix it, right?
That's what I was saying, we might as well make it clear across the board, so. So really, the only changes then is this 8-38.
Yeah. You know, there was a couple other clarifications above that we had gone over last time in the employee benefits. But it's mainly that because it never talked, when I first tried to get approval from my company, it never said anything. I said that the difference between this and the standing insurance committee was we talked about investments and they're like, doesn't say that in the ordinance. It's like, okay. And Clark and I have been talking about this for 10 years now.
There you go. It's up on the screen now.
Oh,
Sorry.
thank you.
Just took me a little work.
You were great.
I'm not proficient at this at all, so. Cool.
We should have get a 6-year-old here. Handle all that.
If I was home, I would have handed it off to my teenager.
Yeah, right.
Go
Yeah.
here.
Fix this.
Fix this.
Make it happen. I don't care how it happens. Just make it happen.
Yeah, so, I guess the main things under employee benefit employee pension benefits, and we should make sure we feel comfortable with everything that's in there, because we talk about, in here, it talks about us providing comments and actuarial assumptions to the town manager as appropriate. So, right now, it seems like sometimes the presentations to the town manager, he makes a decision. I guess we can still comment on the assumptions.
Right.
Even after the decision's been made, but. And then it sort of gets us to consider if we want to change either the fiduciary or the actuary, right? And then we have to report to the council, the town council, sorry.
Yeah. Do other towns have something similar in their plans?
Yeah, I copied most of this out of the pension piece of this, mostly out of the West Hartford one. That's what I started with.
Cromwell and Clinton don't even have one.
Don't even have an ordinance. Yeah.
They don't have a group,
They don't have any committee?
just managed by the town.
Well, you
and
don't
members of the town.
need it. The town can make the decision, right? You don't necessarily need a
So,
committee. West Hartford's probably one of the stronger ones. They have a pension board that makes the recommendations to the council.
They do have a pension board in Cromwell and they do, but that one is kind of limited to questions regarding receiving pension.
Yeah.
I mean, John, if you made the changes that were talked about last time, except for, some of the window dressing with making sure the language is consistent.
Right.
Looks like an ordinance.
Yeah, like any other ordinance.
What? It's better now. So I guess we need a motion, whether we make the changes to make sure that it's consistent where it says council, everything is town council. And then approve it. Okay. Got something else?
The only question I have is to report to the town council on the financial condition plan. It probably should be in writing.
Oh, I thought it would just be a presentation.
Either way, which way do you think the town council would?
Well, I'm just saying, so if we're gonna do it in
Well, presentation would
presentation,
be-
who would do the presentation? nor are they the chair of the committee, who I sit in the council. So it'd be kind of silly for me to sit over there, make a presentation and come over out here and vote on it.
Well, it's just gonna be a presentation, not necessarily have to vote on it, right?
Right.
It's more informational than anything else. Well, it could be one of us. Clark could do it. I can do it.
Yeah, I mean, I guess we can decide who makes the presentation, but I think, yeah.
Is to be decided by the committee.
Yeah.
And I may not be in this role, we make the presentation, so,
Right.
but whoever sits as chair of the committee shouldn't have to make the presentation because he's making it.
Yeah, this just sort of leaves it open-ended, that somebody has to do it.
Yeah.
From the committee. And again, that was pretty much right out of the West Hartford one.
Does anybody have to review this in the town? Like-
Yeah.
Like the,
It will go to Ben. It will go to
We go to
the
our town
attorney.
attorney,
Go to the town attorney and,
then we go to the town council.
yep, if you
and then it
guys
would go
move
to a
forward to
public
say
hearing.
you want it to go to council, I'll send it to Ben tomorrow.
Yeah.
And when he's done reviewing it, if there's no issues, we'll send it to council.
So you're assuming I can make it consistent by tomorrow? With the town council wording?
Yeah.
Well, we wouldn't- we
We'll
wouldn't
look
get
if you get it.
We probably wouldn't get an agenda to the end of March anyway.
Yeah, after budget, right?
Well, I mean, we're doing agenda setting tomorrow,
Oh, yeah.
so we wouldn't have that, it wouldn't
Right,
get,
yeah.
wouldn't get it that fast to
Right,
turn
right.
around.
Yeah, so it probably won't be to April.
So it probably wouldn't be, well, we'd have to be it has to be on the council agenda twice and then it has to go for a public hearing.
Right.
So it probably wouldn't happen until the middle of April, end of April, at the most,
Okay.
the earliest.
And your meeting on the 14th is pretty packed.
If 14th is pretty well packed, yeah, it's a lot of crap out there. Right,
Oh, boy.
So,
yeah, so that's where the money for the pension went,
Yeah.
that's where that money went.
so with those changes, anybody want to make a motion?
motion to accept changes or what have you, a motion, the hell out of that.
Change the ordinance.
Yes, motion to change the ordinance.
Second, does anybody want to second it?
I'll second it, David.
Thanks.
Thanks, Steve.
All those in favor?
Aye.
Yes.
Aye.
Anyone opposed? Motion carries.
Yay. Fruits of my labor for 10 years.
Next on that's only thing we have for old business, I believe. So we have remarks by counselors, by committee members. Next meeting, we'll leave that to you, Janet,
We're gonna stick with quarterly.
I think
So-
quarterly is good. I think
But you want to get more towards like July, so we have end of June results?
probably would make more sense, I think, right?
Yeah. Yeah, I
So
think we
then, I guess that question becomes, is any of the renewal information for the benefit plans, not the pension, that's already gonna be decided by
That's in the
town
budget.
council?
Yeah,
Okay,
that's in the
already-
budget. So he did it based on our claim history for the rolling year and updated those, gave them to us, and it includes, as he said, the stop loss.
I'm just
60 to
really,
70%.
I'm gonna be really curious to get that stop loss he does.
To be
I guess
honest,
70,
for the
75%.
town side, we stayed flat to last year. And as you said, the Board of Ed's total went up about 4.2. We had some bad claims last year.
Yeah, we're
And this
staring, we're
year-
staring at a 60% increase on the stop loss rate.
So
and that's-
that kind of, it mitigated the history we had when January of last year fell off and we picked up January of this year. It brought it down for us a little bit.
It's
So,
interesting that a lot of them DTQ the business, because you usually can get competition out there, but
Yeah, well, I'm guessing, you probably know better. I would think with all the drugs out there, the specific drugs, that some of the stop loss costs have gone up.
yeah,
A
stop
lot.
loss is rough. But you always get a new guy in there that's like, we'll do this.
I'll do it.
Yeah,
I'll
I'll do it
underwrite
for half
I want that
yeah.
business.
I gotta grow my business, I have growth goals.
Yeah. Okay, so we'll leave the meeting to you, then the motion's
To you guys.
to adjourn.
Okay, motion to adjourn.
All those in favor?
Aye.
Aye. Anyone opposed? We are adjourned. Thank you, folks.
Nice to see you guys.
Thanks, everyone. Have a good night.
Yeah, it's good to see you in person, right? Can't stand this Zoom meeting. Oh.
There's no recording.
Clark, feel better. Clark, on mute.
I want to say, can you hear me?
Yeah, now we can.
No, I just wanted to say to Tim, this is one of the better meetings I've attended in a long time.
was ready to hit end.
How am I doing?
We need to, all right.
No, go ahead. Okay.
Can you hear us?
Yeah. he
No,
could
no,
still-
I'm just saying it would be lovely to present some of this to the town council and help educate them as well. It's such an important piece of the,
Well, if you want to throw a presentation together, Clark,
You can
you can do it as public.
I'll do it.
To,